I be? What does it mean to just be me? Mm. So tired of having to choose. Okay, let's go. Cool. What up, everyone? Welcome back to Financial Education and Business. Right now, I'm going to try to cover a little bit of SOFI, just talk about what's going on with the company, and they're going to be reporting earnings, which is really exciting. We're looking for decent numbers tomorrow. Everybody's really excited. I'm also really excited. So the hope is that SoFi hits one of their best earning sessions, and that we and the stock goes up. I mean, the goal is I'm hoping for 34, probably 34 if they report earnings. But why do I think they're going to report decent earnings? Is if you look at Q3 earnings have come out, and a lot of the banks have already reported earnings. And when you look at like companies overall in general, reporting their earning report has been amazing. But when you look at banks specifically, you see that JP Morgan right here, they beat earnings. JP Morgan Chase, they beat earnings. So they beat on revenue, they beat on EPS. You look at Goldman Sachs, they beat on revenue, they beat on EPS. BlackRock, I mean, Citi, they also beat BlackRock, also beat Wells Fargo, also beat. They beat pretty well, right? I mean, revenue was 1%, but I bet you that SoFi's earnings are gonna, be they're gonna be better than this. EPS, it looks like EPS Wells Fargo was able to beat EPS by about 1.73, so which is pretty good. Um, so that's the section here. Let's look here and look at Bank of America. They also beat on earnings. Um, let's look at here, U.S. Bank. U.S. Bank beat earnings. U.S. Bancorp, they beat earnings, revenue, and EPS. Bank of BNY Mellon, they beat on EPS and revenues. They got the travel company. We're not gonna look at that. Let's look at American Express. American Express beat on revenue and EPS. Ally Bank beat on revenue and EPS. Look at this EPS beat. This is what I'm hoping, if not more. This is about what I want. What I want to see SoFi do, really just beat up earnings very significantly. So we looked at these and we're seeing that they're already beating earnings, and I don't see why SoFi cannot do the same thing. Really, and also on top of that, like a lot of the new customers they've gotten is going to be also in there. They're probably going to have one of the better um, quarters, where now there'll be 1 million new customers they've added to their platform. Today, I mean, you got Waste Management. They got, even though they beat, I think the stock just got demolished. Oh, revenue they didn't beat, and EPS they didn't beat, and the stock, when this happened, it got beat pretty badly. One day, yeah, there they are. There was about 213, and they went down. Initially, they got beat up all the way down to like, what is this, 200 and something, like 203 or so. So they kind of got beat up. They didn't really beat earnings very well. Waste Management. So tomorrow is a big day. You have a lot of big companies reporting. The MSCI UPS is coming out with revenues here. This is also going to impact a company like company like Amazon. because Amazon have their own A to Z just clients that they deliver their products to. You got PayPal also reporting earnings and SoFi at the same time. So most likely, I think what's gonna happen is we're gonna get SoFi really reporting amazing numbers. PayPal also probably reporting amazing numbers. They've partnered up with pretty good companies. They partnered up with Google. They partnered up with additional other companies. I forgot the names of. But one of the reasons I think that you know that SoFi I think is gonna do decent reporting tomorrow is because of this. When I look at Citi reported earnings and they beat it all in all. Wells Fargo, they beat it as well. And so JP Morgan, they beat it. American Express, they also beat earnings. Ally Bank also beat earnings. This is a smaller company. I love what they do. They Ally Bank is pretty cool. Very Gen Z millennial kind of style bank, but we're seeing all these banks reporting earnings, and they've done an amazing job, beat top, bottom line, and so I don't expect anything less for SoFi, especially this quarter. They've probably added, some are saying, 1 million customers for the year. So on top of everything else, they're gonna probably have more customers, more product they've added to the product line, like options, crypto trading is also coming up, level 2 options also there, sending money internationally. So they have a lot of products that they brought on board. And what does that do is that gives them, as they add more products, they're going to have more incremental revenue that's going to come in, or revenue based on fees. So we're going to see all that information, and especially the biggest point tomorrow is, did they add at least 1 million new customers Q3. So this is SoFi is going to have a big day tomorrow, and I think a lot of people are expecting that it's going to report some really good numbers. So throughout the day, SoFi had a great day. After market actually went even higher than it did during the day. So as you can see, during the day went up 3.41%, and then they closed at almost 31. Technically, they did hit $31.04 today. So that was the highest until the market closed after hours at 8 o'clock. So my guess is tomorrow, it's never a good sign when a company is running into earnings. That means things can go down in the morning. Also, another thing about after hours is that the volume is not as much, so it's easy to move the stock in pennies or in dollars. And so most likely, I think what we're going to see is the stock running tomorrow. The earning report itself is going to be coming out at 7 a.m. in the morning. And then they're going to do the call, I believe, at 8. And then obviously it's from 8, probably a 45-minute to an hour earning call. And that's going to be the rest. But I think, and also, Kathy Wood sold a whole bunch of shares of SoFi today, which I don't know why she does this, but she always sells SoFi before earnings. But I have a feeling that SoFi is going to report great earnings. I did buy some shares. I didn't only buy shares. I kind of went a little bit more aggressive. I went in about 2 months ago. I actually bought SoFi. I bought SoFi 2x leveraged. So SoFi goes up by 1. This one here will go up by 2%. So as you can see, throughout the day, SoFi went up by 7, by half whatever this is, and then after hours it went up by half whatever this is. So if you have a winner and you think it's going to keep winning, in a month or 2 months or 3 months, this is usually the strategy that I would use to get into those winners, to leverage my gains technically. So obviously I work at an institutional firm. I cannot buy and sell whenever I want. I have to go through this like pre-clearance and all this. So I have to at least hold for a month. But so this is the play that I've been doing. When I see a winner, I will go to X leverage and just hold the stock. I did this for SoFi a couple months ago. about 2 months ago. So far, it's been pretty good. I also did the same thing with I also did the same thing with AMD, AMDL. Um, I did this when, oof, I don't even know, at least maybe 3, 4 months ago. Um, so before they had this crazy jump, I woke up one morning, and it said like 21%. I couldn't believe it. 41%. It just kept going up. But I bought it around here somewhere, and it initially made that pop and then came back down and then just exploded to the upside. But when I see convictions stocks that I think are have great potential, usually I will buy it on some kind of leveraged, 2x leveraged, and as I grow my conviction, I will continue to add more. I don't buy all the shares that I want at the same time, but I was able to accumulate a good amount here, and luckily my HSA allows me to invest in 2x leveraged stocks. So I practically went all in my HSA on AMD, and so had a pretty good run in my HSA. So that's where I went 2x leverage in my health savings account, and I've at least 200 to about 200%, maybe 2.5% on my AMD. That was like months ago before the stock took off. But I have a feeling AMD seems to be one of those generational companies. There's no way that AMD is going to be one of those companies that's going to be left behind while you see Nvidia and other institutions just taking off, doing so well, providing these chips, the training chips specifically. But my thing for AMD is they're going to be the next inference winners. AMD won the training, they did well, but then when it comes to the chiplet architecture that AMD has, the and then the partnership they're getting. For example, today they partnered up with Department of Energy for like $1 billion for health, energy research, and like two other things. And the stock had a little, had a good day, to be honest. Around the close of market, right here, as you can see, they went from this specific leverage position obviously moves twice whatever the stock does. So around the close of the market, it just kind of took off. And AMD's been seeing like really good times. Like since I've gotten in, it's just been on the grind up, doing just fantastic bounces. I don't think this is the end for the company. We're gonna see the MI 400 when the next chips comes out. I think we're gonna see that some of the largest institutions are going to partner up with AMD and want to upgrade to the new chips. That's the best part about AMD is upgrading to a new chips is actually not too expensive versus Nvidia's chips. Nvidia's products are very expensive, and so sometimes institutions are they don't have all the capital in the world, so that means they may just hold the stock for a little bit. I mean, they may have the product, but it's going to be super expensive to move from one product to the next easily if that next product is going to be super expensive. But I think AMD's chiplet architecture allows for upgrading at a lower price, and allows these large companies to be able to kind of use this chiplet architecture to be able to build on top of one another. So anyways, so this is AMD. I've gone a little bit leveraged on it. So far it's been a good play. Doesn't mean it's a right move for the long term. Usually do not want to hold these for too long, but as long as they're winning, the thesis doesn't change. These are not, it's not a bad direction to, it's not a bad strategy. But obviously on the downside, there's a lot of risk. Um, and so yeah, so SoFi, to go back to SoFi, I think tomorrow it's going to be pretty good. There's a lot of I think positive market structure overall for SoFi, like thinking about what's going to happen when rates go down. FOMC comes out. Jerome Powell says, "Oh, we're going to be reducing rates by 25 basis points, which is 0.25%." So when they do that, I think it's going to lower interest rates. It's going to encourage borrowing, and so people are going to go shopping. They're going to use their credit card, or they're going to do business financing, or go get their mortgage, and they can do all that through SoFi's products. So I see great opportunity for SoFi here. In the long term, and if overall market structure is looking really good for them. When I say market structure, is not the technical structure. I really don't do too much of technicals here. I'm more of talking about the economic market structure. Looks pretty positive for SoFi. And so yeah, so I just wanted to cover that. I think so forecast, let's see statistics. So let's look at what analysts are saying. So analysts are saying that SoFi is above what they think the price should be. Most analysts, the highest analyst is saying it should be $31 a share. The lowest is $12. SoFi is not going to $12 in the next year, in the next 12 months. And then the average analyst right now, they're saying about $21.3 a share going into the next 12 months from now, which I doubt it. If the company keeps with the products that they have, continue doing their crypto products rollout, options number 2, level 2 rollout, they allow users to send out more than just money internationally outside of Mexico and South America and as well as Africa. I think they're going to be able to make that revenue. And then analyst recommendations overall, like as we can see, the number of buys throughout the year stayed. Strong buys have stayed at 3, just the regular buys have stayed at 3. Holds has gone up by 1 over the couple months, and then the sells haven't really changed by much. Like we're not seeing more and more analysts saying it's time to get out of the company, it's too expensive, or they're not going to deliver on their promises or their revenue guidance. And nobody's saying sell. To be honest, no one. Maybe some of the 3 analysts might say sell month over month, and they don't change the rating, which is ridiculous because when the company is getting almost 1 million customers, maybe this quarter, and they're producing more products, this has to change. You can't just continue rating the company at a sell when they have so many more products that they're coming out with. So apparently, these 3 think it's too expensive, but nobody's saying that this company SoFi is a strong sell at the current price. So here they are. A lot of them are saying SoFi is overpriced. He went from 23. Truist went from 23 to 29. That was an upgrade, but they're still down 3.25% from where the price is right now. So they're definitely wrong. The price is $33. They're saying it's supposed to be 29. You see another upgrade here from JP Morgan, another upgrade here from 14 to 18. Like, what the heck is this? And then Goldman Sachs from 21 to 24. And then you got Morgan Stanley. This analyst's rating is just terrible. So he's half a star. And it looks like his rating, a lot of them, as you can see, no one's really above 30. I mean, you have here Mizuho at $31 and saying is a buy. But everybody else is, as you can see, is around that $20 to $25 a share. But as we can, obviously they are all wrong. The price is above where it's supposed to be. And then expectations. So this is the physical year expectations, revenue growth, right? So Q1, this is December 31st, 2020, fiscal year 2020. They beat EPS. Now the revenue grew by about 27%, 72%, 55%. and then 36, 27. Then going at the end of the year, they're supposed to be at 32% revenue growth. I don't see why that would slow down. EPS, as you can see, their EPS is actually getting more and more into the positive. They finally hit positive EPS last year, and they're expected to continue hitting those positive numbers, or which is their earnings per share. So yeah, from what analysts are saying, the stock is on track, and actually above what the analyst ratings are. And then let's just check out what's going on in the X world. Let's go SOFI. So yes, Kathy Wood did sell a couple $1 million, I believe, of SOFI today, which kind of sucks. So data-driven investing, obviously he's well known on X as one of the SOFI guys. He covers everything about SOFI and really gets into the numbers very deep. SOFI hit an all-time high after hours. I honestly wouldn't read too much into this. It will very often run like this prior to their earnings release, and usually not a good indicator one way or the other if of what happens in the report less than 12 hours until we get the numbers. So I think I was saying this previously, that it's not always a good thing when a company is running pre-earnings. All this means is it's going to run after the earnings, is just going to dump. It's better when a company is just kind of still, maybe barely moving to the upside, and then earnings come out, and then the price reacts based on what's going on the earnings. Otherwise, as it is already, SoFi has expectations just from almost everybody that it's gonna beat numbers, and it's gonna produce like really good numbers this quarter. And some are saying, this is a turnaround quarter for SoFi. Not a turnaround, but like a a point of trajectory where the company is actually going to be looked at seriously by other institutions. So, so this is going to be a very important thing for SoFi here. So you usually don't want to see that. You don't want to see the stock running, but it is running. SoFi did go up to $31.04 today, which is, not a bad thing, but you don't want it to run at all. So I'm saying here, I guess, yeah, the expectation tomorrow can be one or two things. Can be both. We're going to see SoFi go to $25 from where it is right now, or we're going to see SoFi go to, let me put this here, or we're going to see SoFi go to $35. My assumption would be probably going to hit in the 30s. I don't think all the run that it's had, it's not just due to euphoria. I think they're gonna produce the numbers. At least that's my assumption. And so I think we're gonna hit at least 30s, if not any more than that. So if you look at some of the analysts around SoFi, you're gonna see that they're expecting actually really good numbers. And I think I kind of agree with like data-driven investing. He's provided really good numbers around SoFi, and he does really good analysis. He gets into the numbers, the number of individuals that sign on to the product and everything else. And this is kind of his thesis around why SoFi might have like really good earnings. So he's practically saying that Q3 we're gonna have at least SoFi website traffic is above like what we've seen historically. So this is what is kind of driving that idea, like SoFi might actually hit those new members. So this is quarterly new members. So as you can see, this is over 800 quarterly numbers. Q2 of 2025, it looks like they are over 800, and they're saying most likely going to hit that almost million member mark here. This is member versus download per day. So this is just kind of saying, the number of members they have is quite there's a large relationship here uh, with an accuracy of about 91%. So the download numbers go up, the number of subscribers go up each quarter, and so that means the users are not downloading and just deleting the app, or downloading and and getting rid of it, or maybe they may lose customers, but like overall they retain most of their customers. And so he's saying that there's about 90%, 91% probability, sharp ratio, that the downloads are pretty close to the number of users that they produce. So he's saying here in Q2, um, about they did a little bit over 9,000 members, and so this is the expected Y chart. Um, Original personal loan. So obviously the personal loan business is going up, and then there's honestly a big number for SoFi, where even the government, like Trump has talked about how they have student loans that they have on their books. So the government has about $1.6 trillion in student loans, and so they're thinking, you know what, uh, let's sell these student loans to the public market. So there's potential there that the government can sell these student loans, and SoFi is going to be one of those winners in that specific area. So SoFi, this is their well, we can look at some of these numbers here. Student loans, yeah, so the third quarter is historically very strong for student loans. And I think as the government kind of shifts away, and right now I think they're saying anybody that has student loans, they have to pay it back. And if they don't, they're actually gonna go into your bank account and actually take money out. Or the next option is, sell it to a company like SoFi. SoFi is also actually getting great numbers from a perspective of like home loans. When you look at there was data that came out where the number of SoFi customers that were going to like DocuSign, or that are getting pushed via DocuSign, was up. Some user found this information, and so when you're using SoFi, there's only like a few reasons why you would go to DocuSign, and the assumption there is, well, they have to sign some kind of home loan, so they're getting pushed to DocuSign to complete that signature and send those documents back to SoFi. So there's an expectation that these numbers can go up for SoFi. So he's saying that he thinks that the home loan program is going to hit an all-time high quarter three at about $950 million. So this is the 30-year fixed mortgage rate. It's finally going down. It has been a 7. People have not been buying any homes. When you have mortgage rate at 7, 6, when historically we've had it at 2 and 3, people are not buying. But as the mortgage rate goes down, buyers are going to step in. They're going to start entertaining the market as the mortgage rate continues to go down. And SoFi does home loans, does student loans. So they're gonna reap that benefit of rates going down. So FOMC is this week. So Jerome Powell is gonna come out and make that decision. Most likely, is gonna be going down, reducing rates by 25 basis points, which is probably gonna go down by 0.25%. And so that, as rates go down, I think you're gonna see a lot of things. You're gonna see home loan interest, business loan interest, a whole bunch of different products open in the marketplace for different types of investments. Revenue, lending. So net interest income only goes one way for SoFi. Lending revenue split. So as you can see, this is lending net interest income and lending non-interest income. So lending interest income, these numbers have not slowed down. Now with the home mortgage and student loan products maybe coming along, the government reducing the number of student loans for tuition. As the government pulls away from this, students are going to have to find like financing outside of the government. And so where they're going to go? They're going to go to a company like SoFi, which SoFi has created a good demand. And SoFi actually started as a company around student loans. So they know how to market to the right type of student. They know how to do the process A to Z. So most likely, they're going to benefit from a lot of the student loan issue that students are going to have. So as you can see, so lending net interest income is going up. We're seeing lending non-interest income also going up, but it seems like it was a lot more. They used to depend a lot more on the lending non-interest income, but overall now the lending net interest income seems to be driving the overall. So financial services, this obviously um, is doing well. Q2, they hit about $30 per member, so quarterly average financial services per member. So how much are they making for every single member they have? So somehow they're onboarding somebody, a customer, and then those customers as they onboard, wow, are starting to find a way to use either more of SOFI's products, or SOFI is able to give them more services, or advertise more services to those users, whether it's, hey, bring over your stock account IRA into our into a SOFI, and we'll give you 5%, or deposit this much and we'll give you 5%. So more and more money gets deposited into the SOFI account. So either SOFI is increasing their prices for customers that are on the platform, or SOFI is upgrading those customers to new services and more money is coming onto the platform. Or maybe SOFI is just getting rid of customers that are not doing anything on there. So the number of customers that have like $2 or $5 on the account are not going to make the numbers look good, so they get removed. Then that means the per member revenue looks a lot better. So I don't think it's the third. I think it's probably the first and the second scenario here. So last quarter, they had about $30.86 member and financial services revenue. Tech platform, the tech platform isn't the best right now. The tech platform is mostly like an API kind of thing where a lot of companies do use it. I think it's called Galileo. And so they're eventually, I think it's gonna get better and better and better, I would think. But right now, it's not expected to create much of a revenue. So we've seen some really green shoots here. Last quarter, the first quarter real growth in full year. So let's just look at the numbers here. We're seeing that revenue overall in the tech platform kind of all over the place. As you can see, into Q 2023, it wasn't very good. Overall, it's been just stable, just sitting there, not doing much from revenue perspective. From a revenue perspective, my bad, from the blue line's revenue. So revenue is going up, but not going up very fast, but it is going up. Is it really contributing to the profits? Yes, but not really significantly more. So they have a product that consistently contributes the same amount, but to show that it's actually not growing. So, and then this is the contribution margin for the tech revenue. So obviously it went down here and we're just flat. So, and overall, we've seen since Q3 of 2023, the contribution margin to here has just been kind of going down, almost at 30%. Corporate, I think this platform was doing okay. So I think if there is a disconnect between myself and others, it will probably be here in corporate revenue. So he thinks data-driven investing thinks that there's going to be a lot more. Technically, this should come down for the last 2 months if they use the capital raise to pay off their corporate revenue, because interest they pay on that, it is portion of the corporate revenue in line. The corporate line item is lumpy, but it just keeps getting worse and worse, and it isn't rounding error anymore. It's becoming a big enough line item to worry about. he's projecting maybe they lose about $65 million in corporate revenue, which is more negative than last quarter, which is about $61 million number. But I would they would love. I mean, data-driven investing saying he would love to be wrong on this, but he's expecting that Q3 they're gonna lose even more, which honestly I agree. Um, if we look at what is this, what is it, what does their corporate revenue mean? So, what is SOFI's corporate revenue? If it works, if it works, mm, all right, those numbers are not coming up, but yeah. So this is definitely is a problem. I mean, they used to make some a little bit of money or barely lose anything, but as time's gone by, we've seen the company continuously lose more and more money. They went back up Q4 23 and Q1 21, and then they just starts plummeting here. Definitely, when you're losing about $65 million on corporate losses, then you need to say make some adjustments here. Um, Adjusted EBITDA guidance, price action. So he's thinking here, we could hit that $35 new flow assumption, good macro. So he's thinking about, low $35. If they deliver on the quarter, and if they deliver the quarter that I outlined above, he's thinking, we're gonna hit the low 30s. I was going for it to like 34 or so, but we'll see what happens here. He's thinking that personal loan is gonna make about 7.6. Student loan origination about 1.55, home loans at about 950 million. I think this number is probably pretty accurate. Lending revenue at about 485. I think this is going to be more. Financial services revenue. I think this is also probably more than he's saying. We got technology, corporate revenue, uh, loss, adjusted net revenue about 950, adjusted EBITDA of about 294 million, net income 135 million, and then EPS of about 0.112 cents earnings per share. So I think this is well put together. So from what we see overall, everything about the company looks good, but the only part that's a little bit scary is their corporate revenue numbers are not looking too good. But yeah, so that is SoFi. SoFi earnings are going to be good. I mean, about what do we think, folks? 35 or 25? I don't know. We'll see. Um, so that was SoFi earnings. Now let's look at what's going on with Kraken Robotics. So Kraken Robotics. I think most people know, what Kraken Robotics do. If you don't know, they have um, a whole bunch of communities out there, but Kraken Robotics is going out there making batteries for companies, different products, as well as like sonar sensing, sonar imaging, underwater imaging products. This is a very small company, KRKNF. Kraken Robotics. This isn't a very large company, but it has had a phenomenal year. This year is up about $269. I've been talking about this company for a while, but they have had an amazing year here. Kraken Robotics, if we go to their website, there you go, we can quickly see the type of products they provide. It's a marine technology company engaging in the design, manufacturing, and sales of sonar and optical sensors, batteries, and underwater robotic equipment for unmanned underwater vehicles (UUVs) used in military and commercial applications in Canada, the Asian Pacific, Europe, the Middle East, Africa, North America, and internationally. It operates in two segments: product and services. The company offers Aquapix, a miniature interferometric synthetic aperture configuration, means sea power, a pressure tolerant deep sea battery. It also provides Kraken active towed fish. This is the catfish. Towed underwater vehicle for high speed and high resolution seabed mapping, LARS, an autonomous launch and recovery system that enables an unmanned vehicle and its payload to be brought up to a host ship. So, so practically that blah, 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 this company, service. They have a product and they have a service. The Toad Cat is a service. They have products like their batteries that they sell, and obviously 3D underwater imaging, sub bottom image, which a lot of companies pay a ton of money to do those kind of services for them. Here's the catfish. So I really don't like the catfish that much. I think it's got a long ways to go to innovate. Obviously, it takes a lot of work to get to this stage, but still, I think they need to do a lot more than they have. The fact that this entire system is an entire boat, and that this little submarine the catfish has to get boarded and off boarded versus just tossing that thing off a coast. I think is a problem. And then I also don't like that this item here is connected to a long rope to take these images. Why can't this thing have its own battery operated propeller as well? But their subsea batteries also is their next product, and this is where this and the lidar service is where they're gonna make most of their money. Obviously, I think most people know that Kraken is partnered up with, I have to say, like, America's #1 defense innovator, Palmer Luckey, Andro, and so and they sell their batteries. They sell, I think there might be some lidar sales going on there as well. And so these are the kind of images that Kraken is able to get. SAS, pathway battery, path bathymetry. I don't know what that is, and SSS. So they're able to scan images and then kind of create some kind of like heat map, and then come up with a great image that companies can use. Imagine this was under a crane that's in the sea that is kind of digging up oil, and their structure needs to get reviewed to make sure everything's as up to code, it's not falling apart. They can send they can use this kind of lidar to be able to get great imaging of their product. And then also think of companies, science researchers that use these lidars to be able to gather what's actually under sea sur- at and under sea surface. So Kraken kind of provides that kind of service. So Kraken Robotics is de-risking offshore installation with its acoustic corer featured in the latest UT2 magazine. It delivers high resolution 3D subsea imagery, helping operators locate buried boulders, map sediment, plan foundations, cutting cost, and reducing risk across offshore wind, decommissioning, and marine construction. So, as you can see, they're coming up with more and more products, and the better, the more innovative they are, I think the better off. There's a lot of companies that still use underwater imaging, but then the lidar imaging, but the image that is returned is actually really, really bad, um, really bad. And so Kraken, the fact that they're able to provide some of a clear image that can be, mission critical, and this and something that companies can make decisions on the image on, is something companies want. So Kraken doesn't just power Anduril UUVs. Obviously, Anduril is one of their practically about, I would say, 70% of their revenue. So, but also Kraken is becoming, partners with other NATO nations. Um, is the SAS, the synthetic aperture sonar, is confirmed that Germany's Grey Shark program gives NATO classic underwater vision for mapping, mine hunting, and ISR at extreme depths. August 2025, they into River battery platform. Yeah, another contribution included the hull design. So here's this multi-mission 4-in-1 payload, most likely uses Kraken products. Um, this is ramping up based on what's going on across the nation. Um, if US isn't going to develop and invest in their autonomous underwater drones, other countries will. So in this case, we're seeing that China is actually building their own. So China's shipbuilding capacity is now about 2 to 300x larger than the U.S., and nearly all of its dual use built to military standards. The U.S. can't outbuild them; it has to out innovate them, because China has almost 3 billion people. And that's why the Navy is turning to Anduril underwater fleet powered by Kraken Robotics. Uh, Cheap, autonomous, asymmetric, asymmetric deterrence, a 1 million drone that can cause 10 to $100 million ship damage. That's how you level the playground. Um, yeah, practically here it is. So you kind of practically have these submarine like things, and then you install these batteries in them. These batteries are obviously proprietary to um, what Kraken does. So this is where most of Kraken's bread and butter, product sales, and the services is obviously the 3D mapping. There was this article that was written. This individual, did really well on ASTS thesis, and then they believe this article is a winner and really good article to kind of show the potential that Kraken has in the long term, especially around um, on-roll relationship. Seems like the success of this company really is based on how on-roll partners up with them. Hopefully, on-roll doesn't just buy them out, but continues to partner up in them. And this becomes just like a positive vicious cycle um, as Anduril has demands. It's going to push Kraken to innovate, and then it's just a vicious cycle where one company is making the younger company stronger and better, innovative as well. Um, so obviously Anduril has the Dive LD, Dive XL, Ghost Shark, and more, and all of these are using some product of Kraken's. Anduril, a hot private company that is still very private, and a lot of people really want to get into Anduril, and but they're private, so you can't buy their stock. And so once a company like Anduril uh, goes public and they say, yeah, we buy our products from Kraken, and they say say this on their earnings or on their S1, a lot of new investors are going to see these kind of companies, and they're going to start bidding them up. So Kraken has a couple of potential here. One just being that, you know, around this just unrolled partnership, but the other is their OTC right now. So once they get into the Nasdaq, I think we're gonna see even more of a run. So but yeah, this article kind of just talks about the partnerships that Kraken has been able to make with the Navy, with the U.S. and other NATO members, and then how we China is not going to stop building all these ships, and the U.S. has to stay up to them, continuing to innovate. Let's see if I can find Nasdaq. So the current bull market started in 2023. Let me go into here. So we believe that Kraken will uplist from Toronto Stock Exchange soon from the small venture exchange. Management confirmed this is being prioritized on the last earnings call. Then we expect further uplist to the Nasdaq or NYSE, possibly by Q2 of next year. This will help bring a new investor base, boosting the stock price even further and creating more catalyst and awareness. So I'm practically saying, if you get it now, you're in early, kind of thing. So yeah, that's Kraken for you. And then we're gonna move on to Jeremy, financial education. See what he's talking about. Looks like he sold the stock today. So we're gonna watch this, and then we're gonna go from there.
Almost $4.2 million here today. What a comeback. I mean, this portfolio was $1.2 million 3 years ago today. And now see it at nearly $4.2 million. Very thankful for obviously what we've been able to achieve and all those sorts of things. Congratulations to everybody out there hitting all-time highs. I'm sure a lot of you guys hit all-time highs in your portfolio literally today. So congratulations to all of you guys, for staying focused and staying invested in the market, right? Incredible. 10 people in the private stock group last week, 10 people hit 7 figures in their portfolio. So signed up 10 of those trophy boxes today. And then we had another 10 people hit 6 figures in their portfolio. So obviously it's amazing to see this sort of success. And this is what happens when you go on one of these big bull runs, man. People are reaching 6 figures, 7 figures, 8 figures. And then smaller investors are reaching 5 figures, right? They're climbing from that 4-figure number up to 5 figures. And unbelievable to see the success out there, right? I posted this on X here today. If you ever want to follow me on X, it's always linked in the description area. And it's been kind of going a little, I would call it mini viral on X, it seems like so far. I said the public count's almost $4.2 million right now. If I sell it all right now, put it into a high yield savings account, I'd make $154,000 a year at 3.7%. Now, of course, taxes plays a factor, but for this little game, we're not factoring in taxes, okay? I said, would you be tempted to do it? Keep in mind, every 10% the portfolio goes up now is $410,000 plus dollars. And so if you think about it, like if we talked about all my portfolios together, I could make multi-$100,000 a year, never worrying about the stock market again. Think about that for a moment. Like that's, to some people, like, dang, that's tempting, right? Palantir stock is still on an absolute tear. Do you remember I did this video less than 2 years ago, buy Palantir stock and don't stop? I did that right here on this channel. It was $20 at that time, right? And I said it was going to 200. Well, the interesting thing about that is when I predicted the stock is going to go up dramatically I thought it was over the next 5 to 10 years. And here today, the stock's already getting close to $200, way faster than I thought, right? Knocking on the door of 200. Here today, it closed at $189. On the 1,000 shares I still have left in the public count of 2,478%. What a life changer of a stock, right? In this video here today, 3 core subjects we're going to get into. First one, why don't I just sell everything, cash out, and become a yield king, right? And just buy treasuries, get 4% on treasuries, and just dip. We'll talk about that. I'm going to explain that. It's a very important subject, actually, because I think a lot of you guys are going to run into this position in the future where you're going to look at your portfolio and you're going to say, dang, I could make $50,000 a year, $100,000 a year, multi-$100,000 a year just being in treasuries or a high yield savings account. Why don't I do that, right? I'm going to walk you through my thought process. This is an extremely important subject we're about to get into. This is life, okay? Second thing we'll get into in this video here today is a position I sold 100% of in the public account here today. We're going to talk about why I went ahead and sold it, and I'm going to show you where I put that money. Okay, we'll discuss that in this video here today, and upside, downside, all those sorts of things, risk profiles. Third thing we'll get into in this video is what if this market just keeps going up? We know November and December are usually amazing months for the stock market, right? What if we don't have the pullback that we could have had, right? We got no 2018, and what if this market just keeps rolling on? What do you do in that situation, right? You know, a lot of people are already like, geez, this market's still so high, it reaches new all-time high. What do we do? So we'll get into all that in this video here today. I hope you guys enjoy this one. The only thing I need from you, if you could please just hit that like button for me. That's all I need from you guys. I hope you enjoy me doing these daily videos, you know, kind of keeping you up to date with everything going on in the market, my perspectives, and teaching you a little something out there with each one of these. That's always my goal, right? Not just to inform you on what's going on out there, but also to educate you on, you know, things that I've seen over my 17 years in this market. If you just smash that like button, that means the world. Additionally, if you want to be subscribed to the channel and see more of my content in the future, make sure you're subscribed here. If you're subscribed, much higher probability YouTube will show my videos. And speaking about subscribe, you guys are all in the first 900,000 subscribers on this channel. We're about to hit 900 card. Those are brand new. When I was in middle school and high school, I loved to play a game called Madden. Okay, this was a football game, and I loved to play this game so much. Oh my gosh. And for me, when I played this game, it was not just good enough I would do like what's called a franchise mode. And it was not just good enough to like, oh, I'm going to win the Super Bowl. I started making all these other things where I was like, let me see if I can go undefeated. Let me see if I can beat each team by even more points, right? Let me see if I can play on the very hardest mode. Let me see if all of my players can win like MVP and all these different things, right? Let's see if I can break new records. Like it was always like, let me see, and it was so much fun. And I would even go into practice mode and just like, you know, make sure everything was perfected. Like this play is a perfect play, right? When I moved out of my parents' house, I moved to this community right here. It was a 1-bedroom apartment, okay? From there, I moved to Charlotte, North Carolina. This was in Glendale, Arizona. Then I moved to Charlotte, North Carolina, and I moved to this community right here, and I got a 2-bedroom apartment. From there, I moved to this community right here in Henderson, Nevada, where I got a 3-bedroom apartment. From there, I rented this house right here. It was a 2,700 square foot house. From there, I bought my first house. This was in Henderson, nearly 4,000 square foot house. From there, I bought kind of like a vacation home in 2020 in Arizona, right? I rent that house out nowadays. From there, I bought the current house I live in Summerlin, Nevada, right? And that's almost 4,200 square feet. And now I'm building a house overlooking the entire city, right? That we'll be moving into next year. And even though I'm thinking about that house and moving in there next year, I'm also thinking about the next move after that. I'm thinking about the Summit Club, right, which pricing will come down, in my opinion, over the next few years, and I'll likely buy a place in there in the next 3 to 5 years, right? I'm thinking about a property long-term, maybe in Newport Coast. I'm thinking about a place in Steinway Tower. I would love to have an amazing place in New York City, right? It goes back to the game. It's a game, right? A game of money. For me, I love the game. I love playing this game, right? And stacking the numbers up, building the numbers up. It's very entertaining to me. It's fun. Not everybody would not feel comfortable living this lifestyle. Not everybody wants to live this lifestyle. In respect, like some people, it's like if they just got to $1 million, they're good. I don't care about playing the game anymore, right? They got to 2 mil, 3 mil. Everybody's got a different thing. For me, I love the game. I love the game of money. This is not stressful to me. It's not stressful for me to worry about, is this market about to crash or about to have a correction? Is the market going to blast higher? It's fun. I love this. This is like I thoroughly enjoy this to the maximum extent possible. So for me to say, let me go sell out of everything to go put it in a savings account, why? I love playing this game. It'd be like me playing a video game in high school or middle school and saying, I don't want to play the game anymore, even though I love this game so much. It's so much fun for me, right? Like, I love the game. This is everything to me. Like, I love this game, right? YouTube. Obviously, been fortunate to have so much success on YouTube. Got 4 silver play buttons. That means I have 4 YouTube channels that have hit 100,000 plus subscribers. And guess what? We just hit the fifth recently. My reaction channel, Jeremy Lefebvre Makes Money, that just became the fifth YouTube channel I've had since I started YouTube in 2016 to now have over 100,000 subscribers. So fortunate. The game, right? It's fun. It's fun. Public count, almost 4.2 million. I'm not even thinking about where the public count's at right now. I'm not even thinking about 5 million. You know what I'm thinking about? I'm thinking about 8 million. I'm trying to position the portfolio right now for the next double up, to get to $8 million, right? And to get through the next mess we have to get through, to then get out to the other side, to then go climb up to 8 million. I'm already thinking about that. I'm not thinking about 5 mil. I'm not thinking about 6 mil. I'm thinking about 7. I'm already thinking about 8 now at this point in time, right? When I'm bored with the game, I'll stop playing the game. And as of right now, I am not bored with the game. I love this game. I love the crashes. I love the corrections. I love the great markets, the bad markets, the kangaroo markets. I love it all. I love it all. So for me to say, once again, some people get stressed out about money. So they're like, dude, if I was in your shoes, I would just sell out and make $250,000, $300,000 a year, risk-free, not have to stress about it. That's fine. This your decision, right? But for me, this is not stressful. This is fun. I love it all, man. Even 2022, as sick as it might sound, when I was getting wrecked left and right, it seemed like every stock I had was going against me. It was still fun in the end. It's part of the process. Like, we're playing a big game here. And, you might say, where's the game go long term? And I got every house imaginable and I could ever have dreamt in every exclusive community out there, right? And my portfolio says there's a ridiculous number. Where's it all go in the end? It's going to go right back to society. It's going to go to charity. That's always been my goal since I started this game with a few $100 to my name. I always said, in the end, I would love to give it right back, and not give it to my kids, right? Because my kids, you think, and I understand a lot of people want to give back to their kids, and they get a $700,000 net worth when they die. They want that to go to their kids. I, completely understand that. But from my perspective, my kids, if they want to make the most money in the world, they're going to be able to make the most money in the world, right? They're going to have all the knowledge from me when it comes to real estate investing, stock market investing, taxes. They have every connection they could. If they care about money like that, they could make more money than I ever made and just destroy my numbers. They could make me I'm 35 years old right now. They could make me look like a joke. They could, right? Because they're going to be starting with such a knowledge base that's, something I could never have dreamt of. So if their goal is to create massive businesses and massive investment, they can do that. That's their own thing. And then if they don't care about the money game, then they won't care about inheriting all that money anyways. That would just be a huge stress to them. Get it? Imagine, you don't care about money. That's not something that's important to you at all. And then you got to inherit a massive fortune. That's just a lot of stress on your shoulders. You don't care about money. And now you all of a sudden got all this money. That's stress. Not everybody's about that life, right? So they shouldn't need my money. So at the end of the day, that'll go right back to society, right? And hopefully be able to do great things at that time. And what it is, we'll figure it out down the road, right? But that's always been my plan. I'm like, if I'm fortunate enough to live a full life and I want to keep going after this thing, that's what we'll do, So that is what that is, right? And as far as, we can call it medium-term stuff, I'm about to turn 36 here soon. I always thought about starting a hedge fund in my 40s. And so, you might say, why don't I just do it right now? I mean, a few things. I want to have a lot more money when I go in and I start my hedge fund. I want to come in with at least, I would say 50 million to 100 million of my own dollars into the hedge fund, like big dog money, right? I don't want to come in with 10 million. No. I want to come in with 50 to 100 million dollars to start my hedge fund, right? And I want to just continue to build a lot of equity with people out there. I want to hopefully make a lot of people, a lot of money by teaching them all the stuff I've learned over the past 17 years, and hopefully take a lot of people that are 5 figures to their name right now to hopefully 6 figures and 7 figures over the coming years. And a lot of people that are 6 and 7 figures right now to 8 and 9 figures, right? Because then when other people are done playing the game, I'm sure there's no one in the world they would rather have managing their money when that time comes than the one right in front of you right now, right? And so, but that's like a down the road thing, right? It's not something I want to do right now. And when I do it, I'll do it. That will be the moment. Until that, could I make a fortune doing that right now? Yeah, I can make way more money than anything I'm doing right now. But I just don't feel like doing it right now. Right now, I love running 1000X. I love running the private group. I love doing what I'm doing on YouTube. There'll come a day probably when we go that route, but it's not right now, right? So that's why I do what I do. That's the longer term goals. I hope, if you wanted to learn a little something about me and like where all the money's going in the end, right? And all the houses and all the stocks and all that stuff, like that's where it'll all be going, right? Number 2 thing here, position I sold 100% of in the public account here today, where I put that money. And we'll talk about what to do if this market keeps going up, okay? Alrighty, so I went ahead and I got spooked. I sold out of my Palantir hedge. Took about a little over a $1,500 loss on that one, PLTZ, and sold out of it completely in the public account. I got spooked, man. I haven't felt comfortable with this one the whole time. Here's the deal, okay? Palantir is on a massive revenue growth acceleration phase. Their margins are skyrocketing. Their earnings per share is skyrocketing. Everything, right? Their net income. And the main issue is the revenue continues to skyrocket, right? And it's, at some point this is going to peak and it's going to start to decelerate, right? But the issue is I don't know exactly what quarter that is. It might be in this quarter they're about to report. It might be in the following quarter. It might be in the following quarter. I would say it's likely in the next 2 or 3 quarters, but I don't know exactly what quarter that's going to be, right? When revenue growth peaks and then they start to decelerate. Now, when that deceleration phase comes, Palantir's stock's going to get obliterated, like 50% downside. But I don't know exactly when that is. And there's a potential here that if Palantir comes through with his next quarter numbers, and let's say they do like a mid 50% revenue growth, or dare I say high 50s, ladies and gentlemen, Palantir will see 200 easily. It might see 250. If they came through with a 60% number, because what ends up happening essentially is people start to extrapolate those numbers out. So if Palantir, let's say, grows the next quarter 55%, then people are going to think the next quarter they're going to go 59%, right? And then they're going to start saying, okay, next year numbers need to come up immensely. They're going to do 50% plus revenue growth next year. People are going to say, oh my gosh, a SaaS company growing revenues 50+% with high margins and an EPS that's skyrocketing with a product that's, everybody wants their hands on. They're going to say buy, right? And, the stock will continue to roll up short term if that were to play out, right? So that's what spooked me here. I'm like, what if my timing's not right? And between now and the Palantir crash, whenever that comes, maybe the stock runs to 200, maybe it runs to 250, maybe it runs to 275, right? I don't want to go through that pain. Like, oh my gosh, right? That's going to obliterate, because I'm 2x, that's a 2x leverage against Palantir. You send that stock to 250, then we need so much downside just to get back to break even. So think about that for a moment, right? That's what spooked me in regards to Palantir. Now, Palantir, we know this is a ridiculous valuation. We know this does not make sense, right? The forward P on Palantir's well into the 300s. You send the stock up even higher, it's going to be even further into the 300s, right? But you got to understand we're in a Momo market right now. What's a Momo market? A Momo market is valuations don't matter, momentum matters. That's the market we're in right now, right? For me, I don't care what market we're in. Valuation always matters. But for most traders, investors, they don't care about valuations in a market like this. They care about where's the momentum at. What stocks are moving, we're piling into those. That's what they do, right? So Palantir, it doesn't matter that it trades at a crazy forward P, 2-year forward P, 3-year forward P. At the end of the day, if it's got the momentum and the high growth, people want in it. And so they just continue to funnel in, and that's what we have going on right now in this market, right? Now, where did I put the money? Well, I put the money in TSLZ. I went ahead and finished off my hedge here. So that's a 1% hedge for the portfolio. Portfolio right now is a little under 4.2 mil. It's a $43,000 plus hedge. So we can say it's roughly a 1%. Usually in Q4 of almost every single year, I like to hedge the portfolio, the public account, with a 1 to 3% hedge. Okay, I'm doing a 1%. So I'm done hedging now, basically for a long time in regards to the public account. Okay, now you might say, why Tesla, right? When this is a stock that essentially is kind of like a Palantir in the respect of if the market has momentum, like Tesla will continue to move up. Yeah, that's an issue, right? This market keeps going risk on for the next month or two. I'll be sitting on big losses here. Like when I say big losses, I'm talking 15, 20%, maybe 25% losses in regards to this, right? But I'm very convinced that Tesla sets up much better than Palantir for downside risk when the market does start to move to the downside. The fundamentals are not there for Tesla. The fundamentals are there with Palantir. That's a big difference. Palantir and Tesla both trade at silly valuations, super high forward Ps. Both stocks have crazy momentum when the market's moving up, right? But here's the thing. Tesla doesn't have the fundamentals to back. The revenue growth is embarrassing, and that might go back negative again, especially given that now the tax credits are out, right? The earnings per share is plummeting for the company. It keeps plummeting quarter after quarter. You look at the latest quarter, EPS was down 30+%. And that was on a GAAP basis and non-GAAP basis. Disaster, right? The margins are, awful for the company. So all the fundamentals are really, really bad in regards to Tesla, right? Now they've taken away the tax credits here last month, right? And look at like the search term on Google Trends for Tesla. It's in a massive downtrend now at this point in time. You can't give away these cars. Look at Tesla Model 3 Google's trend. Look where it's headed here. Look at Tesla Model Y Google's trend. Yeah, it got a nice spike up before the tax credits expired, right? And people were like searching, like, maybe I'll buy a Tesla because, they're about to take the $7,500 away. And now ever since that, it's just plummeted in regards to any interest in people like searching Tesla and Model 3, Model Y, those sorts of things, right? Additionally, and that's in the United States. Additionally, in China, by the way, in Europe, let me just say Europe's a complete dumpster fire for Tesla. Like no one wants Tesla in Europe after the stance Elon Musk took and all those sorts of things that we don't need to get into. But yeah, Europeans are like their numbers are so bad in Europe, it's shocking. As far as China goes, their market share continues to decline significantly. They used to have 16% market share of the EV market. Now they're down to about 7%, and that continues to plummet for the company overall, right? And then in terms of Robotaxi, like that's what people are excited about, right? Robotaxi is not going to generate this company any significant revenues or profits for years to go in the future, right? Tesla's barely at the stage where they want to start removing some safety drivers. You know what early stage that is? First, you got to then remove all the safety drivers. Then you got to prove out that your cars can run well and not have a bunch of issues with safety drivers. Because if they do, have issues and there's no safety driver in there, like everybody's going to be posting that all over the place, right? People love to record these rides. That's going to be posted on YouTube and Instagram and TikTok and X. X might try to throttle it because obviously Elon Musk owns that platform, right? So they might try not to show that if it has some bad moments, but it will be seen on other platforms, right? And so that's a whole situation. Like you've got to prove that out. Then you've got to start getting approval in more cities around the United States. It's a long process. If you look at Waymo's years ahead of where Tesla's at, right? Waymo, they're only operational in a real way in 5 major cities. They have other markets they're testing right now, but the only markets they're really in are Phoenix, San Francisco, Los Angeles, Austin, and Atlanta, right? And they're testing right now in Miami, Washington, D.C., and supposedly testing in Tokyo as well, which is pretty exciting, right? But that just shows you like how slow a process this is. And so then you got to market, then you got to get everybody aware of it, and then you've got to also undercut competitors, and you got to keep your product great. When I say your product great, I'm not just talking about, get somebody from point A to point B safely. I'm talking about you got to undercut price on your competition, right? And you've got to have all your cars be clean, smelling good, like all these annoying things that add up the cost immensely, right? That a lot of the Tesla folks have not factored in yet in regards to that matter. It's a whole big process, right? And it's going to take years to get the company to a place. And the funny part is people are going to find out when Tesla gets there is it's not going to be nearly as profitable as people think, which is going to be rather hilarious. But anyways, that's to play out. You may say, okay, I'm very confident Tesla's going to eventually go through a bad, spell in regards to that stock, right? Remember the saying, markets can remain irrational longer than you can remain solvent. So if you wonder, like, why don't I go like big money, betting against Tesla here, 2x leverage, more than a 1% hedge. Why don't I go 10% hedge? Who's to say they don't just keep buying up the stock, even at ridiculous valuations? Like anybody could pay anything for a stock. You can make an argument that Tesla's a crazy valuation at 150 PE, forward PE, right? So people are willing to pay 300 forward P. Who's to say they're not willing to pay 500? Like, you know what I mean? Like at the end of the day, that's the thing about the market. You never know when the next big roll down is going to happen. And at the end of the day, they just have kept buying up the stock. They look for the momentum. That's got the momentum and they go rolling it, right? So Yeah, there'll be a day of reckoning coming for that stock, but it's hard to get your timing perfect. And that's why when I hedge, I go small. And at the end of the day, if that hedge ends up being correct, I'll make a phenomenal return. Like if all of a sudden the market goes down, 10 or 15%, when I say the market, I'm talking the NASDAQ, over the next, let's call it over the next month or two, guess what? I'll cash out with a 50% profit on that, right? Be beautiful. And then flip that into long positions. But, November and December are usually great. Like, who knows? Maybe the market just continues to roll higher and Tesla just trades at even a more ridiculous valuation. Like, you never really know, right? So just something to keep in mind there and why I don't go big on that. I go big on sure things. When Tesla goes down is not a sure thing. I like to bet on sure things, companies that are at very attractive valuations that are going to have great growth in future years. I'm going to make a lot of money on, right? That's when I go big, right? Meta 2022, that's when I go big. Alrighty, next one up here. What if this market just keeps going up, right? Which what people are wondering, like, what do you do? Do you take profits? Do you not take profits? Do you stop buying? What do you do in this environment? Do you start betting against Tesla stock and Palantir? Like, what do you do, right? Okay, so here's kind of my 2 cents in regards to this subject. One, you take profits where returns don't make sense over time. So when you run your projected numbers, and I'll show you in just a moment, how I think about these projected numbers, right? When you run your case on a stock, okay, and you run those numbers, and at the end of the day, the CAGR does not say a very attractive return on your base case, you got to cash. You got to take profits in that stock. As bad as you might not want to, if the return profile does not say a good return, you take some profits. That's just the way it is. And part of the stock market is taking profits. Do keep that in mind, right? Most of the time, as a great long-term investor, you're just buying and holding, buying and holding, buying and holding. Selling doesn't happen that often. And usually, actually, when I sell, it's like a big subject, right? Like, oh, I sold the stock. Like, it's a big subject. Whoa, I buy stocks all the time. How often do I sell? Doesn't happen very often, right? So, but it is part of the game. And there's going to come a moment where every stock you end up selling at some point in time, right? It's just what ends up happening. People were debating today. I was watching CNBC. They were debating Berkshire Hathaway stock is going through a really tough time, right? I called that out years ago. So the day Buffett announces he's going to step down from that company, it's going to have a whole re-rating of that stock. And so even though the market's going completely risk on green, Berkshire Hathaway stock's doing horrible because it's not getting the Buffett premium anymore, right? And I explained that happened to Apple. I explained that happened to even Wynn stock with Steve Wynn. When Steve Wynn got kicked out of Wynn Resorts, had a whole re-rating of that stock. When you got some legend, I mean, if Elon Musk left Tesla tomorrow, stock's down 50% in a month, right? Like, it's as simple as that. When you got a legendary CEO in place, people are willing to pay a crazy premium just because that guy is in place, right? And so Berkshire Hathaway now, Warren Buffett's going to be leaving next year, and people are like, oh, not willing to pay what I used to pay for Berkshire, right? And so keep in mind, imagine if the market was in a downtrending market right now, Berkshire would probably be down 20 or 30% right now, right? Which for a great company like that's kind of crazy. But you got to run your numbers. If the returns don't make sense, you got to cash, right? 2, focus more on value and dividend stocks. When the market starts to get really frothy is just a fancy way of saying the forward P on the S&P 500 starts to get very elevated, which is what we're in right now. Focus more on dividend stocks and value stocks. That's where your best opportunities are, because when you're in a frothy market, people don't care about value stocks. They don't care about dividend stocks. They care about Palantir. They care about Tesla. They care about momentum. Look at stocks like Palantir and Tesla, since those are ones we're talking about in this video. Look at those stocks at the end of 2022. Where was Palantir stock? $7, $8, something like that, right? Where was Tesla stock going into 2023? About $100? No one. Tesla stock was down like 70+%. Palantir stock was down 70+% from where those stocks peaked at in 2021 to where they troughed at the end of 2022 going into 2023. Those stocks were down like 70, 80%. No one wanted those stocks because you know why? The market was going down. The NASDAQ was down 35+%, right? The S&P 500 was down like 25% or so. So no one wanted Tesla. No one wanted Palantir. We're in the completely opposite situation. Everybody and their grandma wants those stocks. They're the momentum, right? But you know what they don't want? Dividend stocks, value stocks. Look at how so many dividend stocks and value stocks have performed since 2020, that end of 2022. A lot have done horrible. A lot of value and dividend stocks I look at are down 20, 30, 40, 50% because no one cares to own those right now. It's not that the companies are suddenly bad. It's just people don't want to own those. They want the momentum, so they funnel their money into the momentum stocks, right? Guess where money starts to funnel once you start to get a downtrending market for any significant amount of time? Significant amount of time meaning 6 to 18 months. Guess what? Money starts to funnel right into the value and dividend stocks, right? So that's where you want to look at when the market starts to get really frothy. So where I'm going to be focusing a lot of my capital, especially if this market keeps going up in November, December, right? Let's say big tech earnings come out, these companies nail it. The market just keeps, climbing. Next thing you know, we got an S&P 500 well over 7,000. At the end of the day, I'll be starting to focus even more on dividend stocks and value stocks, right? Because remember also, when it comes to dividend stocks, those pay you out those dividends when the market's down, and then you're able to funnel that money into long positions of growth stocks. So you don't have to worry about like, oh, I want more capital to invest right now, but I have to sell a stock for that. That's no fun. But if the company's paying you out dividend money, right? You got a bunch of dividend stocks in your portfolio, they're paying you that out regardless. Like if you own great dividend stocks, it doesn't matter if you're going through a recession. It doesn't matter if the stock market's crashing. They keep paying you out those dividends every 3 months. Credits just keep coming into your portfolio, keep coming in, and then you're able to buy great growth stocks with those, probably at cheap valuations, right? Would you not like to buy Palantir at $7? Would you not like to buy Tesla at 100, right? Would you not like to buy Shopify for $25 in 2022, right? What about Netflix at 170 in 2022? Would you like that? If you had that dividend money coming in your portfolios, you were able to buy, right? Next thing up here is if you're a big dog, hedge, right? Big dog meaning you've got many, many, many years of experience in the market. You also have massive portfolio. You can hedge. There's a lot of different strategies. I go through those in my private group and in some of the curriculums. I think even one video is like 50-minute video just explaining different hedge strategies, but you can buy puts, right? In the money puts, you can buy out of the money puts. You could even make an argument that selling covered calls could be a hedging strategy as well, right? There's a lot of different other put strategies you can do. You can buy like inverse ETFs as well, right? Which is obviously something I did there. But you can also buy like a 2x leverage ETF against an index, right? You can buy call options on an inverse ETF, right? You can buy put options on a leverage ETF that's going on the upside, but you could buy put options. There's so many strategies you can do in regards to hedging, right? But that's really advanced stuff. Like I said, only if you're a big dog with a lot of experience and a lot of money in the market does that really make sense, at least in my personal opinion, right? Obviously, everybody's free to do whatever they want to do. It's just my 2 cents on it, right? So in regards to running numbers and running projections, right, looking at 1000xstocks.com, this is my Palantir projections. I'm going to show you my bull case, base case, and bear case for Palantir, right? And I'll show you why it's made sense for me to cash Palantir shares like crazy this year, right? So I have them doing 40% on average revenue growth under my bull case.
Okay, Jeremy. All right. Now that was a great session there. I think I agree with him. I think there's got to be, after some hype market right now, I think there's a lot of everybody's focused on these hyper growth companies, and specifically, small market cap, that are gonna go, 3, 4, 5x, and eventually that market will have to die down. And I think investors are going to look for something a little bit better that they can invest in, maybe something a little bit more safer. So I'm thinking most likely we're gonna see something like the whole investment strategy kind of shift from growth to value companies. You know, some company that comes first into mind is a company like Google. I think they got great potential. A company like Amazon is a great great value play there. PayPal. So there's some like good value companies. Let's see. Um, let's just do a quick search and look at value stocks. Value stocks. Um, I definitely think Amazon is definitely on the list for value stock. Value growth looks like there's a Russell 100 growth total return. Yeah, so top 10 undervalued high quality stocks. Our model is screaming buy. All right. Um, all right, that did not give me what I wanted. What are some good value stocks to buy? So obviously there's going to be an AI answer here. Valuation. So some of the best value stocks to consider buying now includes some Campbell Soup, as they are trading um, below their fair value. So usually when I, this is how I do some of my research. Actually, this is where it starts, and I go from here. And a lot of times, value stocks are they are kind of forgotten because everybody's chasing the high growth companies, so they're forgotten. And usually they are like large companies that don't grow really fast, but they're stable, and they get forgotten, and people chase all these like growth companies, and the value stock and companies kind of lag behind. And what they do is investors move away from all these like fast growing companies to the lagging value plays that pay dividend, and then obviously from there, things become investors getting to even like more of a safer ecosystem, um, and invest in those like bonds, so on and so forth. So yeah, so we're seeing here Campbell Soup, the GlaxoSmithKline. I don't even know what that is. Yeah, Caterpillar, ExxonMobil as well. Finding the best value stocks to buy. Cute best value stock right now. Let's see what Bazinga says are the best value stocks. Let me see. The best value stocks. All right, so you got Taiwan Semi, United Healthcare, SAP, Cisco, Novartis, these definitely are not. We got this is the Russell. This we'll discuss in the S&P 500. So company number one, the S&P Global. I think I really think S&P Global is such a cheat code because this this company, they don't really move that much. So if you're if you want to remain invested like 100% cash in the stock market, but you think is around the end of the major growth period, maybe we're gonna see like some kind of drop in the market, and you want to have some money, um, you know, and if the market drops significantly, the S&P the S&P Global is such a good play, and this is why I kind of say that. Um, let's look at the S&P Global. Maybe they'll have it here. Global S&P Global. S&P Global Inc. So the interesting part about the S&P Global, I mean, this at the max, right, is done really well. But when we look at the year, um, yes, like the company has gone up significantly, and then we saw, for example, in April when the market went down, it went down, but not as much as a lot of other companies out there. So let's look at it here. I think this might be a better chart. SPGI, S&P Global Index, um, overview. So the S&P Global, like, it's really honestly one of the smartest plays here, because the stock really holds on. As you can see, S&P Global is starting to see some gains, and this is where you're starting to see the market starting to rotate out of these like high risk plays. The past 5 days has been doing decent, and as you can see, the past month is up 1%. Past year is down about 28%, and then year past year is about 1%. Year to date is down about 3.3%. 5 years, you're still up. But I just wanted to show you that when the market goes down, it doesn't get hit as badly as a lot of the companies out there that are like single stock or other ETFs. So S&P Global really just kind of trades around this like tight number here. Is in 2025 you see some drops, but it kind of comes down to this level that's about 20 515 ish, like right around here is about the average. um but overall, like, it continues to go up because this company isn't just volatile like all over the place. I think a lot of investors are going to start looking at something like S&P Global, together with its subsidiaries, provides a credit rating, benchmark, and analytics and workflow solutions for global capital, commodities, and automotive markets. It operates through 5 segments: the S&P Global Market Intelligence, S&P Global Rating, S&P Commodity, Mobility, Dow Jones Indices, and then each one provides multi-asset classification. Some offer desktop and products, suits, so on and so forth. But overall, this is a very stable company. I believe they pay dividend as well, at you know about 0.78% dividend. Um, I don't know their expense ratio. Expense. I think there is. I think you do have to pay something. Wait, this is not an ETF, so there's no expense. So here it is. So this is a smart play. S&P Global is almost like a decent value play. So, anyways, if you're wanting to like play a non-volatile market, S&P Global provides a client with financial information services, credit rating, benchmark in the capital markets. So free cash flow about 42, return on capital, return on capital looks like about 126%, free cash flow yield at 4, KRKNF since IPO about 13%. So if we look at these numbers that were provided, the S&P Global rating is up, market intelligence is up, global Platts is up, and then the Dow Jones indices are also up. Next company, ASML. Obviously, everybody knows that ASML is a monopolistic play in the semiconductor. I mean, they have one of the best chip semiconductor research laboratories, and obviously the United States really invests a significant amount into them as well, and just protecting the company. But yeah, so install based revenue is growing. Options for ASML business, install based revenue expected to grow about 12% KIGAR here. Company Novo Nordisk. So Novo Nordisk is active in diabetes treatments. More and more people will suffer from diabetes due to the aging population and obesity. I don't know about that. MasterCard, maybe. Microsoft, maybe. BlackRock, maybe. Thermo Fish, no. So I think out of all this, maybe ADP, Moody, Visa. Yeah, Visa is not a bad play. I think a lot of these companies that are considered just banks or financial companies um, definitely have room to run, just because they they're gonna get I say this re-rating from a perspective of what they do, meaning they these kind of companies used to be focused on one thing, like providing services, banking services, but now due to blockchain and technology and crypto, they're gonna have to get a new rating, because tech related rating, because they're using technology for innovation. So anyways, yeah, so let's see what Bazinga says some of the best value play stocks are here. So 12 best value play stocks. So Stellantis, T-Mobile, CF Industries Holding, Ameriprise Finance, Western Digital, Micron Technologies, uh, Warner Bros. Discovery. I think Warner Bros. Bros are being sold. they're for sale. Their stocks that Netflix could buy them off. Capital One, Finance, Biotech. I don't know. I don't think any of those are definitely. I don't think any of those are like good value plays. Um, all right, so let's get into something here. I kind of want to when I find a company that I like to invest in, this is kind of the route that I take. So usually what I'll do is I'll find a company that I like and I'll start researching them. And my research would normally start on X and YouTube. And I would just search the company name and stock analysis. So in this case, I'm interested in a company called Rubrik. And here is security. So it's securing the world data. And this is where I kind of start and I just go from here. And to see what they do. So what does it mean to have a clean backup? Okay, your cyber your cyber recovery blueprint. All right, so they help companies recover. Rubrik workshop, protect mass mission critical Azure cloud application with Rubrik. So it seems like maybe they back up companies' data. Seems like why an offsite layer of data protection is non-negotiable. Obviously, with AI, that kind of stuff is important. And then what I'll normally do, it's like I'll do a quick look here, and I will look at X and say Rubrik, and see what people are saying about the company. X does provide really good initial review. So how is Rubrik how Rubrik makes money from cyber resilience to AI powered growth? Rubrik's business runs on reoccurring engagement subscription revenue. Out of the 310 million in total Q2 revenue, 297 million came from the subscription, growing 55% year over year. It foundation Its foundation is Rubrik's Secure Cloud, a unified data protection and recovery platform sold to enterprises. Once a customer adopts one product, expansion allows faster new workloads, more data sources, deeper intelligence. That's how Rubrik turns 100K into multi-million-dollar business. So margin tells the story of leverage. Gross margin expanded 81%, driven by better cloud economics. Operating margin about 33 points, nearly break even. Free cash flow 19%, a rare combination of this growing rate. Okay, that's interesting. So this is how they make the money. So revenue, the cost of revenue about 57 mil, and then they got growth and they got gross margin about 60% gross margin. Q2 of 2025. Research S&M margin, research and development. Then they got G&A's gross margin about 27, and then they're in the hole at operating income at about $44 million. That's a positive of about 93% year over year. Other income expenses, looks like they got an expense here. Net income, stock-based compensation, looks like they pay some of the users, some of their employees using stock. Stock-based compensation is a lot here, and they do the net income at loss of about 95 million, which is less loss than the previous year. Okay, so they're still losing money. So Rubrik looks like he might be the CEO of Rubrik. Mindless, spaceless, relentless Rubrik CEO chairman. Okay. Cybersecurity. So it looks like Rubrik is listed as cybersecurity growth rate. So it looks like Rubrik is growing about 50, cyber growing about 46, and then there's everybody else like Cisco, Timber, Octo. Octo, I think this is a Google company. I think. No, it's not. It's not a Google company, but they are cybersecurity. CrowdStrike, their cybersecurity, and also you have Rubrik, which is kind of like what I'm interested in. Rubrik looks like it's $81, maybe to October 3rd. And then, so what I do once I do like my initial perusing on X, I go to FinViz and look at what's going on here. I kind of look at the current price, look at the stock, it's the performance. So it looks like it's definitely gone up. What do we see here? 2025 here, 2024. We see the stock at $40, 32, $40, and now we're sitting at $78. So, 90 some percent, which is not bad at all. 40, actually a little bit over 100% for the stock. Something I noticed here is there's a lot of inside selling. So in October and in December, there seems to be this large selling in December at about $89 million. But overall, insiders continue to sell the stock no matter what happens. So this is the closing price of the stock, and then these bars represent the insider sales. So we're seeing since since March here, insider sales is all have been insider sales, not a single insider buy. So it is kind of worrying for a company like Rubrik. Is why is everybody that is an insider selling the stock? Is it because they made a lot of money? Do they see a negative economic data? Why are they selling, dropping off, a lot of their stocks here? So that's what I'm noticing here is as the stock price has gone up, we have seen the insiders continuously submitting these insider sales. We're seeing significant $89 million. Well, $89 million. Yep. In with just 10 trades. And then here in July 2025, we've seen of about $92 million, 17 people trading. So there very few people selling significant amount of shares, and a lot of them are not just their officers, their directors, chief financial officers that are getting rid of like millions of dollars or millions of shares of the company. Why aren't they buying? I don't know. I really don't know why. Maybe there's some kind of negative sentiment. They don't see the company going again continuously to do well, or maybe they're taking profit because they've held onto the company for so long, and now it's time to, do something, or they're raising money because they want to invest it in some way. Who knows? But at the end of the day, if the company is doing well internally, then you should see some people in the company, the directors, see value at the current price and actually buy the stock. Almost for the entire year, we haven't seen anybody really, for the last 12 months, we haven't seen anybody make one purchase, which is kind of a problem, but not overall like red flag for the company. But it is one red flag that's kind of like, well, what's going on here? What's going on here with the company? So to look at the overall performance of like how have they made revenue, how do revenue numbers look, Rubrik. So let's look at the past year's financial performance. Here we got the income statement. So going back to 2021, fiscal year 2021, we're not going to look at quarter over quarter. So annually, it looks like they're growing revenue at about 4%. So the past in 2025 and 2024, revenue didn't really accelerate at all. I say that the whole AI industry and data secure 41%. Well, I couldn't see that 41. So 41%. AI and everything else. This AI business really, the whole AI industry significantly grew in 2024, 2025, some in 2023. as well. So you would expect a company like Rubrik to pick up on revenue, subscriptions, and then companies saying, you know what, we need more resiliency in our business. So them actually gaining more customers, making more revenue. But from what I see, the company had 30% revenue growth here, and then they just kind of slowed down 2023 and 2024. The end of 24 was a pretty good year, and then obviously going in the beginning of 2025, it wasn't too good, but then picked up again. So trailing 12 month, not bad at all. So far, trailing 12 month revenue is at about 47, and probably going to close out the year at a pretty good revenue growth. Gross margin, the company's hitting the mark here. They're making good headway. They could hit almost $1 billion this year. These are all in millions. So they were able to hit. They went from 280 to 353, 417, 480, 620. They're continuing to hit higher and higher gross profit, while also you're seeing their cost of revenue not slowing down at all. So they're paying more, their cost of revenue going up, but then they're at the end of the day they're making more money. That's a good sign of like a growth, a company that is continuing to grow. Selling, general administration, that's gonna grow. They are a tech company, so we're gonna see high expenses here. With them being a subscription company like this, these numbers are not gonna always be high. It looks like this is $1 billion. They spent over $1 billion here. Most likely, they might hit another $1 billion here in selling general administration expenses. With the kind of data they have to do, they have to pay a lot of money when it comes to like security, because they provide AI, and then they also have to capture other people's information and keep it in a safe place where hackers can't get into it. So that's going to cost them a lot of money to run, operate as well. They're a tech company, so obviously more likely we're going to see these numbers always high. They're continuing to go up, and then when we come to their operating income, we take off the gross profit minus all these operating expenses. We're looking at losses of about $209 million, 249, 260, 3, $1 billion. So fiscal year 25, as of January 31st, 2025, they are lost about $1 billion. And it looks like major culprit, I guess that's how you say it here, is this research and development, and also operating expense in total. This went and hit over $1 billion. So due to this, they lost $1 billion in operating income, which it's not a bad thing. The company is growing, so they're gonna have more operating expenses overall. Let's just go straight into net income. Shareholders net income. All right, so at the end of the day, this is a company that is losing a lot of money. So when I'm researching a company and I want to buy some shares, I'm gonna say, well, this company is losing a lot of money. It doesn't look like they're losing less. They're actually losing more. This year, more and more and more as the years go by. So we're not seeing them lose less money. So I don't know if I feel comfortable to see, okay, this company is continuously losing more and more money throughout the years, but we are seeing them grow as well. Decently grow. These 2 years were not good at all. Terrible years. But then we're seeing that at least 2025 is looking decent. But I'm not liking that they're losing almost a net income. They've lost about $1 billion, $350 million, $277 million. So their losses continue to go up. So here it is. So 2021 loss. 2025, this is a significant $1 billion loss. So far, trailing 12 months, They're lost about $443 million. Um, I'm hoping that that doesn't continue. This company doesn't have that much money, so because they're losing a ton of money, so they decided, okay, you know what? Because we don't have the cash, we're just gonna pay everybody using our stock price. It's not always a bad thing. We've seen a company like Palantir for the longest time. They didn't have money, or they didn't want to give money. They just had some of the best employees, and they just said, hey, here's our stock. This is how we're gonna pay you. So this is why we're seeing like stock-based compensations go up, and that's how they're diluting shareholders. The more shares are outstanding, the more it dilutes, and they're gonna. It looks like they have continued to pay shareholders using their stock rather than cash because the company isn't making money. I mean, we've seen, even though this is a red flag, if the company is providing value that is just perfect, that is amazing and innovative, the the employees are willing to take those stock-based compensations and say, you know what, the value, which means the value of those, they believe that the value of those stocks are going to be worth way more in 3 to 4 or 5 years versus now. So they're willing, you know what, it's going to grow. So give us those stocks, those shares of stocks, and then they don't get paid as much in their salary. So I don't know. They're a tech company, so maybe that's a good thing or a bad thing, but it's gone very well for a company like Palantir. Imagine all those years you worked at Palantir for 5 years. You've been getting paid in stocks when Palantir was like $12 or 20 or 30 or 50 or even $100, and then before you know it, the stock is now at $200. To give me more of those shares, right? Because now for every dollar that you skipped in salary, that you're paid in stock, is now 2, 3, 4, 5, 100x. So it's not always a bad thing. This obviously attracts very like tech kind of workers, people that they don't really need the cash fully, but they're really good at what they do. They probably still get cash, but overall, we're just seeing dilution. So some people might not invest in this company because, you know what, you're just gonna issue more stock. That's gonna make the price of the stock go down because there's too much outstanding, and then my share of the pie is gonna go down. All right, so company now making money, and paying with stock-based compensation. Then how is their balance sheet looking? Do they have a ton of liability, current short-term liability? Well, let's see. Total current assets. Um, so here's the total current assets, and then here's the total current liabilities. So if I was to compare this with that, so I'm going to highlight it so I can easily see it. So 2021, assets more than liabilities, assets more, assets more than liabilities. Whoops. Here is when they just flipped. They had more liabilities than assets. Here, they had more assets than liabilities, and then trailing 12 months, they have more assets than liabilities. So it looks like they're continuing to build out their short-term assets. To me, it's close to 1-to-1, meaning like they're almost mark 1-to-1 for assets versus liabilities. So it's not a bad thing. I think it just means that maybe they're well leveraged in the short term. If something bad happens in the short term, they have a way to make those payments. Um, but you see this as prepaid expenses. These are not really well. These in a way are advanced payments. This could be like in property leasing or equipment or whatever it might be. Most times like when they need the property to do to have all the data centers and everything else, they might just prepay the property owner for a year or 2 or 3 years in advance, in which they kind of get some kind of discount because they do that. They have receivables, so they know that they have recurring cash year over year. So this is where it tells you like the company is making money on recurring basis. And if they need the money, they're able to sell these accounts receivable to some company, debt collectors company, and then maybe get 80 cents to the dollar or 90 cents to the dollar, depending on the quality of accounts receivable. um, so, and then obviously who knows what these are, but other current assets. So overall, they have the money to cover short-term assets and short-term liabilities with their short-term assets. The total long-term, now this could paint totally different picture of the company. So we have short, long-term assets, long-term liabilities. Looks like more on the asset side. Here looks like they have way more liabilities. Here they have more liabilities. In 2024 they have way more liabilities. And here more liabilities, and trailing 12 months looks like they have more liabilities. So it looks like this company is quite leveraged, so they're using a lot of debt um, for operations. So in essence, this is a tech company that is in its growth stage. They're taking loans to run their company. um, See, and then yeah, they have this long-term unearned revenue, meaning like clients have given them the money and the company hasn't performed their obligation. um, so they have to perform that action to be able to collect all this revenue. So obviously they put it on here as liability of performance. So they this isn't technically like a liability in a way. I mean, they just have to do the performance, and then if they don't perform, they have to give the money back in some way. Um, so total liabilities. So it looks like the company is operating at a very leveraged way. Um, if they are going to be a growth company and they're sitting at a whole bunch of debt, that might slow them down from any type of growth, because they can't invest into research and development as much as they wish. They can't pay the employees as much as they wish. So it's never a good sign, a company like this, which I was interested in investing, but their financial statement kind of turns me off. Like, I maybe give them some time. Um, when we look at, when we're looking at their income statement, this is a company that was losing, almost $1 billion. I think they lost $1 billion last year. So, which turns me off, and I'm not gonna entertain the company overall. Like, I think they're in the right industry, but um, I think that they're definitely not a company that I would be interested in, just because there's CrowdStrike and other companies that I can invest in that do these services, and they have a better let me see, they have a better balance sheet and income statement. um, Let me see, there's boom boom boom. So if I'm gonna invest in data security, I would get into um, Rubrik. I wouldn't get into, maybe I'll get into like CrowdStrike or something like that. um, So something like this. So obviously, with AI being a big topic and literally going to take over everything that we do, having security for all those AI systems is going to be more really important. And a lot of times nowadays, a lot of companies, like think of Amazon Web Services, a company like that needs some kind of security, but also they need like resiliency. If Amazon Web Services is going down, they need a second, like almost like a Amazon Web Services 2.0 that could also run on the back end just in case something happens. So overall, to say, like, yes, Rubrik is one out of a whole bunch of other companies that have built a moat for themselves in what they do. So I would go through and look for a company that actually is better investment, rather than I would buy CrowdStrike. I think that's a great company. from a balance sheet, I think they have a really decent balance sheet. Okta, this is also another pretty good cybersecurity company. That Cisco, that's another, you know. So there's a whole bunch of really good options. So if I search on here cybersecurity stocks, there's going to be a lot of options. So who do we have here? Yep, CrowdStrike, Microsoft, Okta, and then obviously Rubrik is still at the top here. Fast growing business, but you don't want a fast growing business with all that debt. That's the scary part. Um, but obviously, the company is hot in the stock market. Um, Okta is a lot of people just this is more like a lot of people use Okta when they're when they're creating some kind of product, like especially like in Google. Um, I almost used this. I forgot what it was called, but this is the largest cybersecurity companies. Jan, Lidos, Checkpoint, Zscaler. I mean, I would go for Zscaler. I would go for Cloudflare, Frontnight. I'll go for CrowdStrike, Palo Alto. So yeah, um, I think I think I was trying to research, just do research and see if this company is worth continuing to look into. I think I kind of changed my mind. So what's going on here is that um, the stock price is way above what the way below what there a lot of the forecast is saying. So the forecast right now is analysts are saying, this at the highest level, the stock could hit about $130. At the lowest 70, and then average it could be $106 a share. Um, and right now, they're saying a lot of analysts are saying this is a company that is a buy. Strong buys across the board. June, July, August, throughout the months, it's been a 5. The buys have stayed consistent. Looks like one analyst dropped to not a buy, um, and then holds. Looks like the hold numbers didn't change, but nobody's really saying sell at all. So analysts are still pretty positive on Okta. I'm not positive. I just don't like their financial statement. For a growth company, they're over leveraged, I think. Um, and then who is saying the 130? CIBC is saying that they increased the rating price from 125 to $130 a share. Wedbush to 120. So they rated it at 120. The stock is at $77. So according to them, it's undervalued. But if we are still in economically in a growth or high growth market, then maybe there's potential here. But like all the companies that are needed to make the runs, I think they've made those runs. And I don't know if we're gonna, if we have like a year of this kind of industry to continue to grow. But with a lot of with the capability that AI provides, there's going to be a lot more companies coming up with all types of like AI products. So potentially, that does create some business, recurring revenue business for a company like Rubrik. So yeah, analyst forecast looks pretty positive. Looks like it's kind of going down here from the number of coverage, but nobody really saying sell. So I I wouldn't be interested in this company, just because if the market turns and we have really bad market, what's gonna happen? Like they have they have so much debt. They're gonna have to continue to pay all this debt while also continuing to provide the services. So if the market turns, goes negative, these high growth companies that are leveraged like this, that can't even afford to pay their employees with cash, but instead offering them stock, how are they going to cover their other operations? Other customers aren't going to say, like, the customers are not going to say, they're not going to be able to pay their electric bills with the stock. I don't think, also, business insurance isn't going to accept stock. um, their lease is also, they have to pay property leasing and other taxes. The government is going to say, yeah, give me some of your stock to compensate for that. So they're going to have to find other ways to reduce that liability and not lose, and watch out at their net income. The fact that they are at, lost $1 billion as of January 3rd, 2025. It's not a good sign. Maybe maybe they can. This could be their turning point, right? Because we noticed that, yes, they went from 18 to 4, but so far, as of January 30th, 2025, they're at 41% growth. Maybe this is a turning point for the company where they actually start generating really good revenues, and the revenue grows from 4% to 41 to, consistently grows even better. Maybe we just gotta zoom in and look at the numbers a little closer. Revenue, from a quarter over quarter perspective, is from quarter over quarter perspective, revenue is growing, decent. So from a quarter year over year, looks like dog. That's what I'm gonna say. But then from quarter over quarter perspective, looking at, let's say, even 2024 from Q1, looks like they took an L. But then 1%, 10%, 16, 38, 35, 38%. So 2024 growth doesn't look too bad. Going into 2025, growth from quarter perspective looks actually like a decent number. Q1 is 38%, Q2 is 35%, Q3 42%. So this company is growing very fast, especially in the era of like AI. They're growing their revenue, at a decent rate. At the same time, their operating expense, right? We're seeing this number tick up, which is not a bad thing. I'm sorry, operating expense. Operating expense here kind of tick up. So 2024, from here to here, we see this operating expense stay consistent, but slowly kind of ticking up. And then Q1, it just kind of came out of nowhere and almost like a 4x'd their operating expense, and then they dropped here, and then they're averaging about $300 million in operating expense. Q1, up to here. How do they already report Q1 in 2026? Kind of confusing. But looking at here, they're obviously, losing almost, 800 million. Lost less money here. Operating income looking better. Quarter over quarter perspective, the numbers look much better versus year over year. And net income, we've seen year over year, their net income sucks. It's really bad. So Q4 numbers look pretty okay. They're kind of just consistent. 89, 81, 86, 97. And then Q1 2025, $732 million loss. And then the numbers have kind of just, dwindled down, less and less net income loss. And this is what you want to see. This is a good sign. And obviously they're paying, a lot of shareholders through stock-based compensation. Let's look at their balance sheet one more time, but quarter over quarter. Current assets versus current liabilities here. It looks like their assets are sitting, about almost $900 billion for Q4 and 2025. And while, their current liabilities is, not as bad. So quarter over quarter, the company is growing. The numbers are looking better once you zoom in. Just looking at their current liabilities from a graph perspective, it's consistently just kind of ticked up just a little bit, Their current assets kind of not growing very fast, but as you can see, the July of 2025, it just exploded to about $2 billion, which is right here. Total liabilities, again, also exploded. At the same time, their total assets exploded. So looks like total liability 1.5 billion. Looks like they had more liabilities than assets here. More liabilities, more liabilities, more liabilities. So this company operating with a lot of leverage in the long term. Still, from asset to liability ratio, quick ratio, they're not looking too good. And then the final thing what I'll do is I want to learn a little bit more about the company. So Rubrik stock, and I will do a quick review of some kind of like YouTube video. Maybe the CEO was talking about a month ago. Let's check it out. This is about a year ago. This company, those are old numbers. Rubrik, this looks like AI. This might be a good one to look at.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 4.
Hey everyone, welcome back to Chip Stock Investor.
Hey everybody, this is Nick, and the other voice you just heard is Casey. You'll see our faces here in just a second about that.
Actually, not till the end. Sorry everyone. You're gonna have to listen to our AI-generated voices until the very end. AI trash, as someone recently commented.
Thanks, Internet. You're very gracious.
All right, for today's presentation, we're going to be talking about Rubrik, and this subject we discussed on one of our recent live events.
Okay. All right, Rubrik stock multi-bagger opportunity? Question mark. Let's check this one out.
Is Rubrik the next multi-bagger opportunity? This is what I'm going to cover in this video. I will talk about Rubrik's business model, financials, valuation, and risks. Before I move on, I just ask if you can take a second to smash that like button, subscribe to the channel, and let's continue growing together. I want to clarify this is not financial advice. I'm not qualified to give financial advice. This is simply my opinion. Please do not buy the stock based on this recording. Rubrik offering cloud-based data security any shares in Rubrik stock. Now, Rubrik operates as a cybersecurity and data resilience company, primarily offering cloud-based data protection and backup solutions. Its platform, Rubrik Security Cloud, provides immutable backups, data threat analytics, data security posture management, and automated recovery workflows. Rubrik's revenue is heavily subscription-based with a strong focus on ARR. It targets enterprise customers with high-value contracts, emphasizes cyber resilience rather than just threat detection. Now, you may now think, how is Rubrik different from Palo Alto or CrowdStrike, which are well-known names in the cybersecurity? The use case for Rubrik is different as it focuses on backup and recovery rather than threat prevention. Now, Rubrik does have competition. Key competitors include Veeam Data Platform, Cohesity, Druva, etc. But Rubrik is growing much faster than their competition. Now, let us move on to the financials. Rubrik is trading at $77 at the time of this recording with a market cap of $15 billion. Year to date, its lowest price is at $53 and highest price is $97, which tells me that this is a volatile stock. Based on the past 12 months, revenue of $1 billion, the price to sales ratio is above 15. This is expensive in general, but Rubrik is growing fast. So this ratio could be less than 10 in a year or two. Let us look at the past 12 months performance to get a sense of how things are going. The revenue is $1 billion and the growth rate was 47%. This is impressive growth. Gross margin is north of 80% as this is a subscription business. If I move a bit down, I see numbers that are not too attractive. The selling, general, and admin is crazy high at $938 million. Now, to get to 1 billion revenue, they had to have 1.2 billion operating expense. This is concerning and leads to doubts whether this is sustainable. However, I will give them the benefit of the doubt and assume that they can still grow if they reduce the marketing expense after a few years. Now, look at the bottom of the snip. Stock dilution is absolutely terrible. In less than a year, the share count went from 123 million to 190 million. This is crazy. This is probably the reason their free cash flow was slightly positive. But it does not change the fact that the dilution is out of control. So how much revenue can they make by 2030, which is 5 years out? So in other words, can they continue to grow like this fast? Remember, they grew their revenue by 47% in the past 12 months. One factor that helps is the dollar-based net retention rate, which is 120% plus for this company. This tells us that their clients like their product, so this is good. Another aspect is Rubrik claims that the addressable market is $50 billion and they're only at $1 billion. This is good to know, but we have to keep in mind that there is competition as well. So overall, I am okay with 3 billion revenue by 2030, which is triple of their current revenue. I think this is possible. So now, what about the valuation? I am assuming 3 billion in revenue by 2030. I am assigning a price to sales of 12.5. Remember, currently their price to sales is 15, but it cannot go on like this till 2030. It has to be lower, but not as low as 10. Current outstanding shares are about 200 million. Rubrik is diluting shareholders like crazy, left, right, and center, as they are really far from making profits and need to conserve cash. I am estimating there will be another 100 million share dilution. Based on this, the 2030 stock price would be $125. Based on the current price of $77, this is a gain of 62%. This tells me that the stock is not a multi-bagger opportunity at $77. Now, of course, this estimation is based on fundamentals, but a lot of people may not focus on fundamentals. Now, if the stock goes under $60, there is an opportunity for 2x in 5 years. So as of right now, I am not interested in the stock at $77. I will think about it if it goes below $60, but since this is a cybersecurity field, if one is a momentum investor, this could be a possible trading opportunity, but be careful as this is a volatile stock. I'm staying away at this moment. Let me know what you think about Rubrik. Let me know your thoughts in the comments. And thank you always for watching.
thinking about going solar, but not sure whether it's worth it for your home?
Joining me now for an exclusive interview before the analyst call is Rubrik co-founder and CEO Bipul Sinha. Bipul, I got to draw a bit of a parallel here between you guys and Oracle in that what's happening in AI, what we've seen with some of the biggest tech companies out there, is having ripple effects throughout the enterprise ecosystem. How is it affecting resilience, recovery, and cybersecurity?
Great to be with you again, John. AI is really forcing enterprises to transform their infrastructure, transform their applications, adopt more cloud. And as they are doing these transformations, they need cyber resilience. And that's why cyber resilience is the number one cybersecurity categories, because everybody is worried about successful recovery from cyber attack and keep their applications up and running. Because if your data doesn't have integrity or your data doesn't have availability, AI is almost useless.
The stock bouncing now off the lows of the overtime session, now down about just 1%. Tell me, you've been balancing your revenue growth and your cash flow as well. How are you thinking about that? How are you able to do it as some of the customers out there in the enterprise are very focused on where they're willing to spend money?
We had an exceptional quarter. If you look at our top line, we grew 51%, our revenues to almost 310 million. We generated 57 million in free cash flow, 19% margin. So we are really focused on winning this very large market opportunity that is in front of us in terms of cyber resilience. What every enterprise is realizing is that cyber attacks are inevitable, and they need to have cyber resilience to be able to keep their services up and running. Because digital trust is key to AI, and digital trust comes from understanding that in spite of a cyber attack, the businesses will be up and running. And that's why customers continue to prioritize Rubrik cyber resilience. But we are also helping our customers accelerate their AI journey. We acquired a company called Predibase in the AI fine-tuning and model serving platform. And we announced Agent Rewind that will actually undo actions of a misbehaving agent. So we are really focused on delivering cyber resilience and accelerating AI journey for our customers.
And what does that acquisition, what do your sales motions do for your share of wallet and for the net revenue that you're getting over time?
Every customer has AI proof of concept, and they want to take those proof of concept into production and value realization. But accuracy, cost, hallucination, and operational management of agents are important, and that's where we are focused on. In fact, what we are seeing is that our customers are really worried about misbehaving agents or having autonomous action that is negative to their business. And that's where the Agent Rewind that we launched, which is coming out later in the year, is going to help businesses confidently do AI transformation.
I want to call your attention to an earth-shattering change that's happening in our society that I know you're aware of. AI.
When you specified the bull case and
guys, sector welcome. That where boring things occur, but it's actually a major part of the data ecosystem because data proliferates and you want to back it up over time. And so this company, when I was working at Veeam, was kind of the new kid on the block for backup and recovery. Everyone's like, who's this Rubrik? I heard they have Kevin Durant on their cap table. Like, they're cutting edge. And a lot of the backup and recovery stuff was on-prem at the time. It was sold as perpetual license, and it was done through really expensive field sales motion. Some of that is still true about Rubrik today, but basically this really smart guy, Bipul, he leaves a really powerful VC job. He's at Lightspeed to start Rubrik. And he had invested in Nutanix, which was a data storage provider. And that's where he saw the light. And people, if you don't remember Nutanix back like 10 years ago, they were actually the plucky upstart for data storage and management. And so they had a cool way of doing things that was cutting edge. And he wanted to apply that to backup and recovery. And so they start doing this kind of hardware, kind of software, kind of backup recovery thing, which is game changing when you consider, like I said, everyone is this stodgy backup and recovery company. And then they later undergo this transition from the classic perpetual on-prem license model to the cloud-first subscription-based delivery mechanism. And that's like one line in their S1. That's like a 5-year journey. It is extremely painful to undergo that. And they came out on the other side. And not only did they make this monetization shift, which is really hard to do, they also started doing cool cybersecurity stuff along the way, which expands their TAM. So once again, I was kind of competing against them in a sense when they were only doing backup and recovery. I woke up and read this S1 and I was like, holy shit, they're also doing cybersecurity too, and they're really good at it. And so then their last funding round, Microsoft comes around, they write this big check in 2021 as a strategic partner, pretty cool logo to have on your S1, and that brought their valuation to $4 billion. And so since then, they've developed a product suite that has data protection, data threat and analytics, data security posture, and cyber recovery. But once again, it all just started with data protection.
And say more about what they figured out that these other companies that could have been them didn't quite figure out. Like, what are the forks in the road, and what decisions they made that the other companies that you were part of and otherwise didn't?
Yeah, so they did this thing called an appliance, which is a fancy word for like a piece of hardware to store stuff on. So there were these two schools of thought. And by the way, I can't code. I'm not technical. I'm like the finance guy who's doing like the TAM analyses. So this is like me just like trying to explain it. So don't get angry at me. But basically, this appliance thing was a way to do backup and recovery that involves some hardware. And that was kind of frowned upon by a lot of people, but they made it in a much more efficient way than had been done before. Some people looked at it like, oh, you're actually going back in time to do something they were trying to get away from instead of storing everything in the cloud. But then what they started to do was detect that I have all this data that I'm storing backup and doing backup recovery to. People are also trying to hack the environments that the data is in. So why don't we expand it to cybersecurity? And with like great TAM comes great competition. And so now it's not just like they're competing against the Veeams and the Cohesities of the world. They're also competing against like the Datadogs and Palo Altos, who suspiciously were not named in their S1.
It's amazing that Kevin Durant had this foresight of where the market was going to go.
Yeah, I mean, as if like being 7 feet tall and having a wicked jump shot wasn't enough. Like he's making way better angel investments than me.
That's pretty incredible. Say more about what surprised you going deep on this S1.
Well, first of all, they named that they had 99 customers over $1 million. I was like, bro, you couldn't have got like one friend to get you over the 100 mark. That was the first thing that surprised me. But the second thing was just how damn expensive their sales force is. Okay, so 42% of their employees are go-to-market employees, and if you look at their P&L, Eric, and you add up G&A and R&D and add them together, that's still smaller than what they're spending on sales and marketing. They spent nearly $250 million last year on sales and marketing, which is really expensive. Now you may look at that and say, yeah, but they're growing over 40%. Like it kind of makes sense. Yes, but when everyone wants you to be more efficient and you need to sell through multi layers of your go-to-market ecosystem, it can rack up some bills. And what I mean by that, just for the benefit of listeners, is they also sell through a channel model. So they have a distie and a reseller for a lot of these big enterprise deals. And so a lot of the customers say they're selling to, I don't know, they're selling to Johnson & Johnson. They don't want to have to make one-on-one relationships with all of their IT vendors, like for security, for backup and recovery, blah, blah, blah. So they go through one point of contact, which is the reseller. And so in that sense, Rubrik isn't provisioning their own licenses. It's going through these other two channels, but they also get a rip along the way. So the distie may get 1%, the reseller may get 3%. And then they're also paying the sales force to do it as well. You know, somebody who's making, $300,000 a year, along with their BDR who's making $75,000 a year, and their SE who's making $250,000 a year, and then that person's manager. And so these deals that they're closing are bigger. They are a mid-market enterprise player, but once again, there's a lot of mouths to feed when you add up all the different people around the table who are attaching to that deal. And I'm kind of curious how this evolves over time, because a lot of Silicon Valley sales forces have moved away from this. Like, I kind of look at it as, still like the bourbon and steak dinner travel budget type sales, where you have these people on the road who are very expensive and they're taking people out to dinner. It's just like an older way of doing business that was very popular in like 2005 to maybe 2015. And they kind of still have that Salesforce vibe.
And is that sort of going away, or do you say that as that's kind of like just a relic that is likely to stay, or is that a risk, or how should we interpret that?
I look at it a bit as a risk because it's extremely expensive to pivot away from. And someone could argue, well, how are you going to get into the enterprise with like a PLG deal? And I agree with that. But at the same time, you have to be really careful about your unit economics. So before they were doing these perpetual deals where they knew pretty much the entire amount upfront that they would get, and it's pretty easy math on paper. A recurring revenue stream is much better in the long term, but if you churn and also had that expensive field sales motion, you're kind of screwed, right? So as long as their retention is still strong, that's great. But the other thing I look at, Eric, is they're still losing on paper more than 300 million a year. I think it was like 358 million or something. The bulk of that's sales and marketing. So if I go through and say, how does this get to like sustainable profitability, like within like a stone's throw, my eyes automatically go to the sales and marketing line. But then I say, can I still generate the same amount of sales if I cut away from that. So it's kind of a catch-22 in that sense. And what I get a bit of heartburn about is like, how do I need a lot more revenue. And in that traditional field sales model, it's kind of like a widget. Like I worked at a place where I was building the sales capacity model for this. And it's like, well, for every $2 million in revenue we add for an enterprise rep, we also have to add this person and that person and this person. And so for their model, it's kind of like, how do you make that work to make the revenue run faster than the expenses if it is like a 1-for-1 that you're putting in to try to get to break even?
You mentioned that Rubrik has entered a few different markets. Can you talk about the either the TAM of those markets or just the nature of it? Like, do you think, are there network effects between those markets? Are there risks that they're spread too thin and someone just focusing on one of the markets will do better? Or how should we think about this?
Yeah. So once again, after dominating backup and recovery, they did expand into cybersecurity, and now you're competing against observability and threat detection vendors, which is great, but it's also scary. It's great because it's one of the most resilient budgets out there. Like there's no board discussion where they're like, hey, let's cut the cybersecurity budget. Like that and backup and recovery, actually, they're probably like the two most economically resilient budgets out there. But you're also competing against, like I said, like Datadog, CrowdStrike, Palo Alto, some of these massive cybersecurity juggernauts who sell multiple cybersecurity things. And that's also a big thing with these enterprise deals. It's a lot of CFOs want to try to do a deal with just one vendor or two vendors rather than a bunch of them. And so that could both be good and bad for Rubrik. It could be good in the sense that a CFO says, oh, great, I can buy my backup and recovery stuff. I can have data protection, data management, and I can also do some sort of cybersecurity. Great. But if they're looking at the cybersecurity budget, I'm not technical enough to know if they address everything that you'd want, but I'm guessing that they're still building out new product suites and because that's the newer part of their model, right? And they said they compete against people who provide cyber, ransomware detection and investigation, security posture management, insider threat detection, data classification, and other data security or data governance technologies. That's like a mouthful, and that's like a lot to compete against. So as cool as it is that they're opening up their TAM, there are some really powerful companies in each one of those, that word salad I just gave you.
Totally. And let's go deeper on their revenue. You mentioned, subscription revenue, you mentioned maintenance revenue and other. Can you explain the contribution and importance of each of these streams?
Yeah, sure. So their subscription revenue was $538 million. So that's the GAAP revenue for last year. But if you look at like what's the exit value of it, it was almost $800 million. And so they say subscription ARR does not include any maintenance renewal associated with perpetual licenses, which we generally no longer offer. And so what they were doing is they were converting customers who would pay them once for something, get the license in perpetuity, and then every like 3 years they would buy what they call a maintenance contract. And that's just so you get the updates of what they've improved on the software. So it's kind of like a bastardized version, honestly, of subscription where like you show back up and pay this like reoccurring amount if you do want the updates. But then some customers say, no, I'm good with this, with the old stuff, I'll just keep it. And so they've been porting customers over to this subscription amount. What's risky about that sometimes is that it doesn't like ramp up immediately. A lot of times you have to sell more seats, or if it has a usage construct to it, you have to increase usage over time. So it's not like it does take an investment to get there, but overall it's stickier, it's easier to forecast, it's more reliable, and hopefully less likely to churn. With these big perpetual deals, I remember we would show up to renewal sometimes and we'd all be biting our nails like, are they gonna want to buy the maintenance contract for this? And so as cool as it was to like take down $1 million perpetual deal, you've kind of taken your whole nut, and then you're showing up later hoping that they buy some dessert on top of that. They did have 39 million of maintenance revenue. So 86% was subscription revenue, 6% was maintenance revenue. And the maintenance was, that renewal for like the upgrades over time. And they said maintenance revenue associated with sales of perpetual licenses of our legacy CDM product decreased by 37.5 million or 49% in FY24. That's actually good. You want that to decrease. You want that to die off. And then they have other revenue. Other revenue, the sale of perpetual licenses. So I guess they probably still had some governments and major schools knocking on the door, and they're like, we don't do that anymore. And they're like, well, how about 51 million? They're like, fine, we still do it. And so they took the money for that. And then there's one other thing to call out. So within their subscription revenue, not all of it is cloud. And so now you're probably like, what are you talking about, CJ? So it's small but subtle distinction. Okay. So some of it is still on-prem, but they pay you in a recurring method for it. But on-prem in that sense is it's not a public cloud. It's not like you're using AWS or Azure or GCP and just paying them a bill every month for it. It's like we are so wary of people hacking us or people taking our data that we built a data center, which is very expensive. And it's actually kind of funny. A lot of companies are actually going back to that right now, which is odd. You wouldn't think, but we built it on-prem and we store it there, but we'll still pay you a subscription amount. So not all of the subscription revenue is cloud, but most of it is.
And do you think, or how long will that remain? At what point will it shift to that?
I think eventually it would all become subscription revenue, but I don't think you'll ever get to a point where it's all cloud revenue. You have like government agencies, you have like super secretive organizations, or even actually it's the old school ones. There are a bunch of like Fortune 500 traded like auto companies out there that like don't trust AWS just because I don't know why, but they've like we don't trust anybody. We don't trust computers really. Just like technologically laggards. I bet there are some people who are laughing at me right now. Like that's not the only reason, but it's hard to get everybody to go over to the cloud and trust them.
So some of Rubrik's numbers are pretty impressive, right? This sort of 133% net dollar retention rate and the subscription ARR doubling the last 2 years for customers over 100K. Say more about what do you think has contributed to this success, and how should we think about the likelihood of Rubrik sustaining a very exciting growth trajectory?
Yeah, net dollar retention, if you deconstruct it, it can go up if you buy more of the same product in terms of seats or licenses. If you use the product more and increase your usage, if you buy net new products, and then it can go down if you churn or use less of it. And so they've had this embedded growth story because of adding all these products over time. So they started with these backup and recovery customers, and they're like, hey, you want some cybersecurity stuff too? They're like, great, okay. And then they also grew with a lot of customers over time. So they were early to the to certain sectors really ramping up. And I think they placed probably some good bets of who they sold to. I remember when I was at Veeam, they were really good in some like fintech sectors and like just things you wouldn't think about. And so that's kind of placing a bet on different customers over time. I'm interested how much though the net dollar retention rate was kind of artificially propped up with the perpetual licenses, because since they started that shift, it's actually dropped. It used to be around 150%, but this could be me just like throwing stones at something that I shouldn't, because benchmark wise, anything over like 120 is really good. Anything over 130 is awesome. So for me to say like they were at 154%, I think, and came down to 133, I'm kind of like being overly strict, but I do wonder if a lot of that was propped up from the perpetual license sales and maintenance license sales, because it coming down kind of coincides with that.
Yeah, that makes sense.
We'll get back to the conversation in a moment after a word from our sponsors. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave...
I want to segue to R&D in sort of increasingly competitive markets. How does Rubrik's strategy drive development of new products and features to stay ahead of the curve?
Yeah, well, first of all, I did the Control F, Eric, and they only mentioned artificial intelligence 10 times. So right. I think we all should hats off to Rubrik. Didn't rely on that. Reddit actually used it like a bazillion times, I feel like, and they're a social media site. But I was saying that sales and marketing makes up more than half of their OpEx, right? But R&D is still growing. So what I always look at when I get one of these P&Ls is I look at the percentage of revenue for each category, but then I see if it grew year over year. And so they said research and development increased by 31.5 million, or 18% in FY24 as compared to FY23. So what I look at is did it increase? And then what was the growth rate in it compared to my revenue growth rate, just as a proxy. So their subscription revenue grew a little over 40, I think it was 47%. And their R&D grew at 18%. And so about half of that, I look at that as a pretty healthy investment they made. If they were investing like more than 40%, I would be like, oh, holy shit, maybe they don't have it figured out on the product roadmap side, or they're playing catch up. Or they would have to have like a really good theory on like why they're doing it. And then if it was under 10% in single digits, I'd kind of be like, oh, they're just kind of milking this install base. They don't have anything new here. So me not being a technical person, that's how I assess it. Like when I look at a P&L and say, are you investing in R&D? But when they talked about what they were investing in, they said 21.2 million was headcount, right? So you need people to actually code it. I guess GitHub Copilot hasn't replaced everyone yet. And then they said the remainder was attributable to co-location hosting fees, so moving stuff to the cloud, and then other software and subscription services. But it's mostly people.
Yeah. So you said you want it to be over 10%. What is the number of sales marketing as a percentage that would make you feel much better, or like what do you think would be a realistic target, a good target?
I think over time you want to try to get it to 30% of revenue. I think right now, if I was doing the rough math, it's about 50%, or maybe just a little bit below. But I look at that as kind of a sustainable model. At the end of the day, you kind of want 25% to drop out of the bottom in perpetuity. And so it's like, what do you cut to get there? And if I'm looking at it, it's like 50% on sales and marketing. It's like, am I playing a shell game almost to keep the revenue up by putting widgets in the sales to pump the sales, but I can never get it low enough to actually have sustainable free cash flow margins.
Totally. One of the things you mentioned at the beginning of the piece is that they basically had to go public. Because of the Press Act, because ideally you want to raise money when you don't need it to have the most leverage. But of course, companies need money. That's why sometimes they go public too. Talk a little bit about their situation and how you see it more broadly when a company's going public, from a position of strength versus a weakness.
Yeah, well, I look at what the pref stack is. This one, I thought it at first was like closer to 1.2 billion. I think some was secondary in there. So let's just round it somewhere between 800 and 1.2. Let's call it $1 billion. They've raised $1 billion. That chunk comes out first. Those people get paid first. So if their last valuation was 4 billion, hypothetically, $1 billion goes back to the investors. Then they split up the remaining 3. What's interesting about this one is they're actually going to IPO at a higher mark than they were at before. So if you remember Reddit, they had to come down. Most of the companies going right now are going to have to come down. These guys raised at 4 billion, which is huge back in the day. From Microsoft was the last one in, but it looks like they'll probably IPO at about 8. But if they were to get acquired by somebody, like I said, for like 4, 5, 6, that's a huge chunk that comes out of the pref stack, and then it gets divvied up. So a lot of employees are probably saying, let's please IPO. A lot of the management, like CEOs and stuff, if they hold common shares, are saying, let's IPO. And that's because upon IPO, the pref stack gets wiped out. Everybody is on the same footing. And then it's not like an unequal economic event. This also has more upside baked into it, where the shares can potentially run and those people can participate in it. And there'll be a 180-day lockup period for those employees on board. That's something to call out, by the way, that everybody thinks that employees are instantly rich, like when they IPO. 180 days is 6 months. Like, a lot can change in 6 months. You can, like, the company can literally, like, the share price could go down like by a lot in 6 months. So you're not like just out of the woods yet.
Totally. And maybe just zooming out a little bit, we started the call by saying that you love reading, S1s. How does this S1 compare, Coley, in terms of when you read this S1 relative to other S1s? Are you like, oh, this is a solid business that really understands the levers, and you're bullish on it, or are you, or not as much? How do you compare it?
So I always read like the CEO statement up front on all of them. This guy, I think, is just like way smarter than me because I didn't understand what he was saying. So I read that and I said, okay, I'm just gonna look at the P&L now. Usually I get pretty hyped up. Like Instacarts I read, I was like, oh yeah, okay, this is cool. This one I was like, I don't really know what this guy's talking about. But I think like this, as my temperature coming out of this one was, if these guys can do well in their IPO with the amount of cash they're burning, there are so many companies just like chomping at the bit to say we're next because they're burning cash, because these guys are burning a shitload of cash, or losing a lot of money. They were technically like within 15 million if you like close your eyes, squint them, and like spin around 3 times to free cash flow positive within like 15 million. But like they're not making money. So like far from a beacon of profitability, but I think they're legit. Like they've done some really hard stuff that most companies fall flat on their face. So like the first hard thing they did was transition from perpetual to subscription, and their growth rate sped up. Like, that's nuts. The second hard thing they did was move into a new TAM, not just a new TAM, but like the most competitive, most technologically like hard to build, tech risk TAM. Like sometimes you move in, you're like, oh, it's just execution risk. Like moving to DoorDash's TAM, you're like, I just got to deliver stuff better, faster than them. They're like, no, we're gonna move into a TAM where we're gonna create cybersecurity stuff better, and they actually did that. So I think that's like a killer combo. And I think what they sell, like I said, is relatively macro resistant. Like you don't just stop backing up your data no matter how poorly you're doing. And I think the other theme that they got across really well, Eric, and they described it well, is data proliferation. So data is exploding. Well, they didn't say we're riding the AI wave. They pretty much said we're riding the data wave, right? Like that's not going away anytime soon. What made me feel like a little bit like is like this isn't right down the fairway. It wasn't super easy to understand. Like, are you a data company? Are you a cybersecurity company? Are you a subscription company? Well, kind of. And so it wasn't like I could fully check all those boxes, but like I think what makes them complex is also what makes them kind of cool. So like factoring in all of that, as long as you still think that like expensive sales reps will be around in 10 years and you're not that like you're not waiting on the edge of the seat for like dividends or something like that, I do think that this is a really solid company who's accomplished some great things.
And let's sort of summarize or flesh out a little bit further by saying, when you specified the bull case and the bear case for this company, if you were really trying to convince someone why this is going to continue to grow, continue to be a great business, say that case. And then if you were trying to say, hey, maybe not, let's say that case. You said a little bit. But
yeah. All right. Bull case would be they're in 2 economically resilient categories with incredibly large budgets at the Fortune 500 level. And what they sell is incredibly sticky and hard to rip out. Like you get a cybersecurity vendor in, like you have a better chance of ripping out the office carpet before you take that out. And like the amount of time and effort and expenses it takes to implement some of this stuff, if it works and it's backing up your data, you're not going to take it out. They also have an incredible NPS score. As much as I think NPS scores are total bullshit, like it's 83. That's really good, and it means that customers like them. I also think that they have a really good understanding of where they sit within their competitor set. They went into it with eyes wide open, and I think it's really hard to have this scale 800 million and still be growing north of 40%. All that said, I think it's a solid company. What's the bear case? Let me think. The first thing is losing money is a good way to go out of business, and if you lose money forever, you certainly go out of business. The second thing is Kevin Durant could tear his ACL at any moment again.
Yeah, the Suns might not advance. I mean, it's very risky.
Yeah, and what else? I think just like the ability to continue to innovate, like doing a lot of things at once makes them valuable, but it like your bandwidth is constrained to a certain extent. No matter how much they raise in this, whether it's $500,000 or $1 billion, how do you continue to do all these things well? Not only execute from like a selling perspective, but also from a technological perspective. Things will continue to change. And it's kind of that idea of jumping S curves of like where you are in the TAM. So I think they saw that data recovery was maybe not growing as fast. It's not known to be like a crazy fast growing forward thinking market always. And they timed it well with cybersecurity. So I think if you're investing in them for the long term, it's like, well, what's the next TAM that they can jump into? And do they have a right to win in that space? And then the third thing is, are they going to be able to sell it, right? And sell it at a level that is unit economic or contribution margin positive? Because if you need a net new sales rep for every $1 million in revenue in perpetuity, that model gets tough. So at what point do you get more efficiency out of your sales force so you can eventually generate profits? That's the bear case. Mostly Kevin Durant, though.
Well said. How should we think about the valuation and sort of the sort of multiples?
Yeah.
And yeah, how should we evaluate that?
So I would only look at the subscription revenue when you evaluate it. I throw out the other stuff. So like professional services, not counting that. The old maintenance stuff, I know it's going away or it's going to show up in my subscription stuff. So I would take the 788, I think they were at, let's just say 800 million. And then I would forecast what's the next 12 months. So if they're at 800 now and they're going to grow, I don't like doing public math. Let's just say it's like a 30% growth rate. Maybe that ends up being 1.1 or something in the near future. I would take that and I would multiply it.
Hey, John, to answer your question. So practically the pricing of Kraken is kind of all over the place, but I don't know about 10x. If it doesn't hit that 10x, I think there's definitely 4 or 5, anywhere from 4 or 5x is definitely on the plate. They have a lot of catalysts. You probably know this already. They're still not listed on the NASDAQ. So NASDAQ listing right now, they're in the OTC market. So once they get listed in the NASDAQ, they have to be at least over $4 a share for quite some time. I think that's gonna give them. There's gonna be new people that are gonna be looking at the stock market, at the actual stock, and that's gonna give them even more valuation. And so the stock will be like on Robinhood or maybe even SOFI or Moomoo. So all these platforms are going to drive even more demand for the stock. So we could see a lot more demand just from the short-term perspective. As you can see, management also confirmed they're going to make this a priority to make sure that that they get listed on the NASDAQ. So if that does happen, you better stay tuned because I'm going to be talking about it. I'm going to definitely report that when it's listed on there, but anywhere between like maybe 3 to 10x the stock can go up. But there's major demand for the company they are partnered up with. You already know that Anduril is a private company that is, you probably know this, they're already using Kraken's products, especially the batteries. And so if Anduril goes public, that's another catalyst, because Anduril, to go public, they have to submit an S1 form, and any big time institutional investor, that's the first thing they're going to look at before they bet their billions of or hundreds of millions of dollars or tens of millions of dollars into a company like Anduril. So Anduril uses Kraken's batteries, as well as I think they might use their LiDAR products. And Anduril is expected to build out a whole bunch of these under UUVs, the underwater drones, and they've started building out this square foot. They started building out these like I can't find it right now, but in Rhode Island, there it is. So Unroll, one of Kraken's like major partners that uses that uses Kraken's product, they've actually started building out this factory. I guess a 200 capacity of up to 200 dive LDs. This is one of Unroll's products. But they've started building out this factory in Rhode Island, which is in proximity to Kraken's warehouse where they make these batteries. So if Kraken does complete this build out, I think there's great partnership. The fact that they are this close gives Kraken a even a closer relationship with the company. So Kraken is small. Obviously, we know they are small. Yeah. So yep. And here it is that all this required for Unroll to fully utilize Rhode Island factory. And the goal is that once they build out this factory in the Rhode Island, there's going to be great potential that they're going to be building out a whole bunch of their dive deep drones, the underwater dive XL drones, and that means there's going to be even more of a demand for Unroll's products. So there's two really big catalysts, maybe even three, to be honest, because if we're looking at like what China's doing, China isn't asleep. They know, there's going to be demand. They're going to need some kind of like underwater defense. It seems like, when they're building out these submarines or even ships, they kind of make sure a lot of the products are ready for not only just to sail or to ship people from location to location, but to prepare those vehicles for any type of war efforts as well. So in this case, like if China does something that's related to like submarines or underwater autonomous submarines, that there's going to be even a re-rating for the products and companies like Unroll and the products that Unroll uses. And so there are three major catalysts that can make the stock really get a re-rating in the eyes of investors and demand for the products the company provides. And I think maybe even the fourth major demand has to be energy, the energy sector, because energy, they don't talk about it, but practically, a lot of the products is related to like deep undersea or deep water research. So a lot of companies that do research use them as well. But like we have how do you say this, like over the sea power plants, I guess, kind of thing, that where they're kind of like digging for oil or minerals. And so if there is some kind of mineral that the rare earth mineral that the US currently doesn't have is found somewhere in the sea, well, there's going to be demand for these types of products, where specifically their LiDAR, I don't see it here, but like they have this LiDAR product that also can, I'm sure that can look into, look under the water and then look below the surface and actually get imaging from there. So this is their catfish. This is their catfish. This is like a towed product that they kind of drag in the water, and companies actually rent this product out to take images of what they see underwater and actually get some kind of like a deep sea imaging where they can make decisions based on the image that this Kraken product takes. So I think this product itself is going to bring a lot of revenue. This is, I guess, be imaging as a service. But these are the Kraken. These are the products that Unroll currently has. So I think this product is going to make them a lot of money. Also, underwater imaging is going to make them a lot of money, and they're partnering up with like a lot of NATO nations. So for a company that is for its size right now, which is about what one, I think it was like $1.6 billion. How big is it? Kraken Robotics. Market cap two. Wow, they finally hit $2 billion. So they're $2 billion market cap. They're still really small. This is a small company, and the products they have is nowhere close to like There's no other company is really that close. Their bigger competition is like Northrop Grumman, like U.S. Defense. I don't know where you're located, but Lockheed Martin, Northrop Grumman, they currently use their product. So use this type of product. But when you think of these large defense companies, everything they sell is expensive. Like nothing is cheap. So because of that, when you have a company like Kraken that can provide the same level or same quality of service, then companies are going to go to Kraken Robotics to buy those products and not the most expensive defense companies. So I think there's still like a lot of revenue discovery and investor discovery overall for the company. He said this is the only stock that has given me profit out of all 10 stocks. Oh man, John, really? What do you hold? I guess you probably are playing like very aggressive investments. That's it. Do you trade a lot, or do you hold your shares like long term? Um, I think I say so. I mean, I've been investing in stocks for a long time, probably for, oh my gosh, since I was 12. So I know the stock market decent, and I've probably done what you've done, where I try to get into the momentum plays and just investing in stocks, just based on like short-term plays. Maybe if that's what you do, I don't know, but like I try to, I've learned my lesson. Oh man, so you invest in 2021 for long-term gain targeting 2030. Oh man, everything you've done should be up right now, John, because the overall, like we're seeing the S&P, the Nasdaq, all of them hitting new all-time highs. So I mean, I feel, yeah. I mean, I don't know what kind of plays you like to do, like what kind of investments, but yeah, that's really sad to hear that, you're 1 for 10. But Kraken is not a bad play. It's a risky play, but it's not a bad play at all. Um, if you're looking for like, a company that still has great potential, um, and is actually, growing, um, I, and cheap, obviously it's not going to give you the exciting returns that you want right now. But a company like Amazon, not too exciting, not too exciting at all right now, but they have so much going on for them, right? They have their entire warehouse that is, people are, they have people actually working, and they're going to replace almost all of them with robotics. And so when they do that, that's going to reduce the expenses they have, the more revenue they're going to have at the end of the day, and the more rating, more, higher prices the stock is going to see. It also is a safe play, because right now, compared to their peers, their stock price has, like, for most of the year has just been sitting around. And so it's going to be something like how Apple has done, sat around for most of the year, and then I don't know where it just exploded. It seems like there's something brewing for a company like Amazon. It's still a safe play at the same time. You get dividends. I mean, they don't pay any dividends. You get a safe company that is a strong company that has, they have Amazon Prime, Amazon TV. They have so many products. But if you're looking for like a company that has, great run in the AI and semiconductor, AMD is not a good. It's not a bad play. I actually bought this company right around here. I played them a little bit aggressive, AMDL. I bought the 2x leveraged, so of course I'm up significantly. But this wouldn't be. I wouldn't play this. I would play just if you want to get into a company that still has price discovery. AMD is not a bad play. They consistently make partnerships. Their AI chips are still competitive with a company like AMD, NVIDIA, I mean. And token outputs are way better and cheaper. And then their chiplet architecture is so much better for just the future of AI. And you made a bad investment like FC, what is that company? FCEL. Oh no, fuel cell energy. Future ready power today. Okay, I see. Power generation. Oh man. Yeah. It's not a bad play. I mean, it's the future of technology. But to be honest, I've never heard of this company at all. So you played FCL, fuel cell energy, drone delivery. What did you use for drone delivery? I bought this stock here at 84 cents. It's gone up to like 11. So I need to still like reduce the number of shares I have. I bought around 84 cents. This company has really exploded. I didn't expect it to do this well, but when I saw the whole Ukraine war that was going on, I was like, this is the future of war. And so I ended up picking up some shares. I don't know what you bought here for your drone company, but Ondas, this company, even though it's ran a lot, they continue to deliver on their promises. They continue to deliver with their partnerships with the government. Palantir as well, they've partnered up with. They have their drone as a service product. They have decent products. So Ondas, I think Red Cat, Red Cat Holdings, also another one that's not too bad. But yeah, who did you play? You said, oh man, that is tough. Drone delivery, Green Lane Renewable, Tattooed Chef. No, you bought Tattooed Chef? Nah, that's tough. So most of your plays are like small cap companies. Oh, they're down around 80%. Oh no. Drone delivery name changed the Valters flat ticker symbol in TSX. FLT ticker symbol in FLT. Dang. Oh man. So okay, John, you're playing. So you are playing. Hopefully, you didn't lose a lot of money. Yeah, Tattoo Chef is bankrupt. Tattoo Chef is bankrupt. Is, to be honest, I think what's going on is, I don't know if you're following like Reddit, like you got a 1000% chance of winning, making these wins. They always talk up stocks, but then they don't look at the fundamentals. Like, okay, usually when I look at a company, I look at what the heck do they want to do? How is their management? It doesn't matter what the company does, but like that is important. But if they have a good management, they can do, they can turn the ship around, get good partnerships. And then the next thing is like, how does their financials look? Because the financials might be terrible, but if it has a good management, they can turn around stuff like that. So a lot of the times the small cap companies sound like a good play, but if they don't have good financials, it really is not a good investment at all. But man, yeah, Tattoo Chef is beat up, man. It seems like you might need invested 54K and then invested 54K Kraken holding for the and my current portfolio value 49. But then you took the biggest L's in the other ones. Okay. Fluence. So Fluence Energy. So something just like the the battery storage company, like something like this that you were looking at. Not a bad company. I don't know. Probably have to look at them. But I invest in something like that. So there's a company called Fluence Energy. But by the way, you have a pretty decent portfolio. And sorry, you have a pretty decent amount of assets that you can invest. But I think you are trying to make, good return as fast as you can. And a lot of times at this point, like the Tattoo Chef, like that is almost not a meme, but like good idea. But obviously they're going bankrupt. But if you a lot of times look at companies of, okay, what are they like? How is their management? How is their financial statement? What are forecasts looking like? Usually this is where I start and I go from there. But you might just need like a reset, man. Look at AMD, look at Amazon. These are really good plays. Right now, I want like one company I have in my portfolio is, I think, it's still got a ways to go, and they're executing. The management team is just top. Tom Lee, I'm sure you've heard of this company. I bought this company around $45. Bitmine Immersion, you probably know, they're between the traditional market and the crypto market. You may have heard of them already, but like you might just need a nice portfolio reset where you have value companies, strong portfolios, strong managers, and also maybe, I don't know how old you are, but depending on your age, you might want to play it kind of safe, because you don't want to you don't want to lose everything you've made. So yeah, this one company that I have, that I'm holding, I bought it around $45 or so. Bitmine Immersion, they buy Ethereum and they add to the portfolio, and so they practically the goal that they have is they want to own 5% of the entire ecosystem of Ethereum. So this is obviously playing the crypto industry. I'm sure you've heard of them. They're called DATs, and they're treasuries. So it's a lot like it's a lot like MSTR. I'm sure you've heard of MSTR. He buys Michael Saylor. He buys Bitcoin and just holds it on the portfolio and continues to grow the number of Bitcoin he has. But this one, he buys Ethereum and continues to grow, and he wants to hold 5% of the total investment, 5% of the total Ethereum that's out there. And right now he's at about 2.8%. But yeah, I mean, you might just need like portfolio reset with like stronger companies. You said that Solar Alliance. Solar Alliance. I have never heard of this company. Of course, is OTC. Yeah. So you get into like small caps, and this company revenue, they're barely making any money. What's another company that you're looking to get into? No beta. Oh man. Oh, John, this doesn't look good. Um, yeah, I mean revenue's going down. Their earnings are kind of, kind of dropping here. Yeah, Trump kind of beat up the solar industry a little bit. I talked to a person that actually works at a power generation, and he says only about 16% of what is captured from the sun is actually, used, transferred into energy by these solar cells. They engineer, procure, and construct sources for solar projects on every scale. Commercial installation solar for small businesses. Yeah, you like to play these smaller. Yeah, man, get out of these like. I mean, they're not bad companies, but they're they're more like you. You love being like a VC, so I have a feeling you're young. You're probably 40 and below, older than 25, and your style of investment is very like venture capital. That's what you like to do. And so because of your venture capital, you're probably very much of like an entrepreneur kind of person, because that's normally like the style of investor that you are. You might be an entrepreneur mindset, VC, venture capital type of investor, and so these kind of things make sense to you. Like, if this company can do this, then but then you might be investing on the if and not like what they're actually doing. One thing is that there are so many companies out there, like, there's so many companies out there that you can make money on. Sometimes it's not worth digging at the bottom of the barrel to find the upcoming company, because you still have a company like AMD, for example. You didn't have to dig at the bottom of the barrel to find this company go from, in the last month to go 62%. You can look at the middle of the barrel, find valuable companies that's making 62% in a month, 114% in year to date, So you said next one, looking at the current, oh no, current water technology. Oh man. So let's see. I'm sure this is an OTC, isn't it? Current water technology. It's gonna be a small cap. Oof. John. 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 Oh, John. I feel like you're yeah, John, like, no, 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 John. So see, look at the market cap, John. This is you're straight up, you're like a venture capital investor. No judgment here at all. Like, like for somebody that has, I don't know how long you've been investing, maybe 3 to 5 years, I'm gonna say, but like usually when people get into the stock market, don't have a lot of experience, this is what happens. Like you see small companies, it used to be at, what, 70 cents or so, but now like there's potential that it can go back up. But sometimes, most of the time, once the companies start going down, what happens is a lot of bad things. They can't cover their expenses, investors want to pull out their initial investments, shorts start to squeeze, banks start to call, employees start to leave. A lot of bad things just hit one after the other. So I'm assuming you're Canadian. I mean, if I was to just quickly look here, John, look at this. Just quick analysis. This is a company. So one of the most important things when you're looking at, especially a micro nano, actually be micro nano cap company like this, the most important thing you want to see is growth. If a company is not growing, especially when they're small, you don't want them at all. They literally had one period where they actually grew 82%, almost 83. If a company isn't growing at the top line, you do not want them at all. So in this case, I wouldn't even touch this company with a 5-foot pole, just because they're so small. The most important thing for them is to grow. The fact that they're not growing, I wouldn't even look a second time. And look, this company can't even pay their employees, so they're giving them stock. So they're doing stock-based compensation. So they're not even worth looking at. Short-term assets, and I bet you their liabilities are just crazy. Look at this. They're very leveraged as well. They have way more assets, more liabilities than they do assets. So next one, looking at, look at Amazon. I think look at Amazon and then come back and like, whenever I go live, I'll come back in 6 months or whatever, comment back on this video. I think that things are going to look way different. Amazon is such a better company. You can even compare this company against Amazon, see which one performs better. And it's not going to be this. You said I'm also losing on, who is this? So you must have like, how many stocks do you have? Oh, you started investing in magnets, huh? Like rare earth minerals. Whereas another energy company? So you really like Canadian Magnets Company Inc. Oh, John. Yeah. Are you trolling me? I'm also losing. Are you trolling me? Hello. I am no mindset person, made rush judgments back in 21. Yeah. Now I'm 32-year-old and don't invest at all. I just hope big by 2030. I think you can, to be honest. It's hard to know. Like right now, like my mindset kind of flipped when I saw that Trump was going to get in office. I was like, well, this guy loves the stock market. So maybe I have the wrong name. Okay, maybe I have the wrong name. All right, so this is the company. So I'm assuming they're probably still a small cap company. They're less than a small cap. They're like nano cap. They're too small of a company. This company's gone up 200%. I don't know what they do, but if we're zooming in, this company is slowly dying off. So it's once a company starts dying off, they're dying off. imagine you just, you know, in 2021 you decided, you know what, I'm just gonna invest in the Mag 7. Let's say you're like, oh, you know what, I will buy Apple, just to see like what your potential return could have been compared to, like, you know, playing some of those companies. You played Apple in 2020, 2021. I mean, obviously, you know, hindsight is 2020, but it was $130. Now the stock's sitting at $268. I mean, since 2021, it's been up 133%. Like, if you look at any of those companies, they're doing an amazing. Like, they're all performing. There's an ETF called Chat. You might find this interesting. So there's an ETF called Chat. I think, like, I think majority of your investment should always be like in these companies that no matter what happens in this world, they're not gonna go anywhere. So this company is called Chat, and then what they do is let me see if I can, maybe this is it. It's an ETF. Obviously, you don't want everything in the ETF, but what they do is they hold some of the best companies in their ETF. So top holdings are Nvidia, Alphabet, Oracle, Meta, Microsoft, and those are the heavy hitters. Here it is. So the top holdings are, as you can see, like some of the best companies in the United States and abroad. And the rest have like 1%, 2%, all, you know what I'm saying? So it's almost like investing in the QQQ, but you can even go through this Chat ETF, find a company that you like in the top, you know, 20, maybe in the top 10 or 15, in the top 10, and go for one of those. At least 50% of the portfolio should be like in one of these like killers. Right now, everybody, for example, right now everybody's talking about like quantum. Oh, quantum is gonna do well. It's gonna be the future. Well, there's one company that has literally the budget to build out the quantum stage. They have the money, the budget, the employees, technology, the resource to actually build out for quantum. That's Google. So Google still got, if quantum is going to be a thing, Google is going to be at the front line, right? So obviously, you know, you're not going to get the big gains. So Google's a strong company. It's not going anywhere. Oracle, you know, Mark Zuckerberg here at Meta, Facebook. You got Microsoft as well at AMD. I think even if you look at AMD, if you look at Alphabet, if you look at Meta, Meta still has a long ways to go. All these companies are, you know, growing. They're at the forefront of the whole AI industry as well. So, and if it seems like you're more of like, you know, you want to get into companies that are a little bit more like small market caps. I keep my eyes on them. I don't really get into them that much, but there is a let me see, the nano caps. There are a list of companies that I look at here. Yeah, get rich scheme, bro. Yeah, like the pyramid scheme, get rich scheme. None of that shit works. But this is these are companies that keep track. I'm not like, obviously they don't all do well or whatever, but like these are the nano cap, like small market cap companies. I don't buy them, but I just have them on my list. Like if I'm reading through something, I'll just add them to the list, and I'll say, oh, I'll keep watch, see where they go. And sometimes you see these companies just explode to the upside, but it doesn't mean, any of them are going to win. But, I've some of these companies I've been looking at for months, and I see them run, and I'm like, oh, why didn't I get in? Like this company has had an amazing run. I didn't buy it. It's been at least like a couple months. As you can see, they're down. But I didn't buy them. I'm like, oh, thank God. That's just one. There is, but like this is where I actually learn a lot of my lessons. It's like, well, good thing I was only watching them and I didn't make any, quick decisions. But this is, yeah. And Kraken shouldn't be like, a big part of your portfolio. Like it's a $2 billion company, still small. The risk to reward seems really good, but like if something crazy happens, a war happens, or the whole China and the US rare earth mineral situation gets worse, Kraken could get hit a little bit, when I say a little bit, I mean it can get hit big time as well. And in that case, like any other company will get hit, not just Kraken. But always, like when you find companies, put them on your list and track them. Just throw them on. I mean, I just use Yahoo Finance and I just say, look up the company, item, make a portfolio, and just see how they do. Like Fubo, for example, I added to Fubo because I was thinking about they're not that big, but I'm thinking about the World Cup that's coming up, and I'm looking at, okay, like, well, are people gonna start watching TV? How would that look like? Would this be a good investment? But overall, you see this company was trading, $1.60. They exploded, and now they're just in this like accumulation phase for the World Cup, and I'm just watching them. The World Cup is not until next year, but there a lot of people might subscribe to their products and start preparing for the World Cup. So Uber, right? Uber is another company that's not going anywhere. They're huge, but if the World Cup comes here, do you think people are gonna, take trips in an Uber? Probably. So probably there's room for Uber to continue to grow. Like Waymo. Waymo, I'm sure you know, is autonomous driving, and they're owned by Google. And they're in New York, they're in Texas, they're here in Florida as well. So when the World Cup shows up, people are going to be ordering these to get from A to B. Autonomous driving is currently being used all around the United States. Nobody's sitting in the car. So this is Google's product. So what, you invest in Google. So these are some of the things that just kind of crosses my mind. You said to rest my portfolio now, I will have to see everything, including Kraken, Robotics. It's a tough decision. Listen, there's this thing called, I'm sure you know this. Ooh, Kraken's about 60%. That's tough. I think that 60% should be between not financial advice, but if I had that, I think 60% would sit between Google, Google and AMD, or Google and Amazon. That's where the bulk of my portfolio would go, because I know those two companies are not going anywhere. Kraken would be 10% of my portfolio. Like, I'm okay with Kraken going to 0. I know it wouldn't, but like, I'm okay with it. But if, let's say, Kraken continues to perform well, it's not gonna hurt for you to just slowly add more, like over months. You might say like this month, $200 into Kraken. Slowly grow that portfolio as the company continues to like perform. So that is risky. That is very and the crazy part is like the most of the market, it can feel like almost hype. Like, look how many when I search Kraken, look how many posts I can read, all the positive sides of Kraken. Oh, why I should buy it, why they're gonna be the next juggernaut, the next Rocket Lab or AST, so I think it's really easy to feel like, oh, I need to get in this before it takes off. Yeah, it's not. Maybe well, buying any stock is a gamble. Like at least you started, right? You got to start somewhere. So at least you started. Most people haven't even started at all. Not even with $10. So the most important part is you literally, even though it hurts, you're learning all the lessons that you need to. So to me, like, I've been doing this since I was 12 years old, and the biggest lesson I learned is literally look at the business. What the heck do they do? Who the heck are the managers? Do they even matter? What have they done in the past? And how is their financial statement? All you've done, John, is you've learned, like, you taught yourself and you paid for those lessons. And so there's nothing teaches you more than, like, I'm sure teaches you more than actually like taking action, investing your money, taking that risk, experiencing the bad side, the good side, So at least you started. Like, that's the positive side, and now you know what not to do. And it's before you buy anything, it's let me understand the company, and is the company, like, to be honest, like, if a company is below maybe 20 billion, you should just avoid it. Just because it takes great management, really good financial statement for a company to get to $20 billion. And to get to $20 billion, there's a lot of companies that have to get, weeded out. All the bad companies or good ideas, but just not really ready for the market, get weeded out. And the good ones kind of shine, and you can actually, those are worth looking at. So maybe, like, if it's under 20 billion, not for John. Kraken, obviously these are the speculative plays. This is a tiny portion of my portfolio. Yeah, it's really I think there needs to be some kind of like investment strategy for a lot of investors, that kind of breaks down the important part of like what to look at when investors start looking at what companies to invest in. Um, I think that Kraken is not a bad investment, but is more of on the risky side. So yeah, but we were looking at rubric. I think I'll probably do an overall video analysis of, like, how to start looking at investments, because how I do my financial analysis and what to look at, depending on the market caps of these companies. As you can see, some market caps are just up and to the right. Some are, up and just down all the way. You see a company like Apple continues to see higher highs in the market cap. But we will continue reviewing Rubrik when we get a chance. But for now, I believe I'll finish up to this topic and continue going from there. Thanks, John, for joining and making this an interesting conversation.
By something between 10 and 12. I mean, they deserve it based on the growth rate, in my opinion. And this is where like valuation becomes more art than science, because you're also betting like, will I want to be holding this stock based on the long-term growth profile more than 12 months out? Like, we use revenue multiples as a shorthand, especially because a lot of companies are losing money, like this company. So you can't use EBITDA or free cash flow multiples, but you're also trying to think like longer term, will this be a good buy then? And so one of the metrics I like to look at is revenue endurance, which is basically the rate of decay of how because it's harder to grow a bigger base of revenue, right? So how long can they take the number and keep it there? So like the growth rate doesn't go from 47 to like 30%. It goes like 47 to 45 to 40, and they stretch it out longer over time. That's the biggest factor of increasing the terminal value of the company. And I mean, it's pretty amazing that they're still growing at this rate. So they would have to, I think, mess something up within the short term to fall.
I can't believe that they were able to shift to subscription, as you said, while also performing even better during the transition and after the transition. How were they able to do it? Does it just speak to an incredible team, or how are they able to do that?
It speaks to how good the product is, because it means people actually used it and ramped up their usage. Because if you port them over one for one, it's going to be less on paper, like, because you have to divide it by 12. And hopefully they took all the same services that they were getting before. I mean, what was wrapped into a perpetual license is you're basically doing the back of the envelope math on what's my LTV on a customer. And if you think they're going to stick around for 3 years, you're basically charging them the subscription equivalent of 3 years and 1 year, and then discounting it back based on the time value of money. And so it means that people bought even more of their shit once they went over to the subscription. And that's pretty amazing. Usually it's kind of like, I'm going to monetize this different. Maybe it's actually a chance for me to step off the treadmill if I was just okay with you. So it means they both retain and expanded their customers.
Yeah. Well, speaking of expanding customers, you talk about how most of their customers are in US and Europe. Do they go even more global, or do they continue to focus on those markets, or where's that next growth going to come from?
Every company tries to go into Asia because they have these huge budgets, and every company comes back like looking like Tom Hanks from Castaway, just like it didn't work. And so they still have single digits in Asia in terms of where their revenue comes from. I remember when I was at Veeam, we were trying to go to Asia, and that was like, that was painful, man. And every country has its own culture, its own way of doing business, its own discounting practices, which you forget about. Like in some cultures, they expect like a 80% discount, so you have to change your list price. It's nuts. But I would say like going into Asia geographically would be big. And then it's also where you follow the population growth, and if companies are outsourcing the people who use your product. So a lot of people don't realize that like a US based company may have a ton of people overseas in like India. I mean, even Rubrik has 25% of their employee base in India. And so you're actually selling, sometimes it'll show up as like where the headquarters is when you sell it. Like it was sold like to a US company, but a lot of the licenses are overseas. So I think you have to follow where the workers are that are using it as well.
Yeah. One other side note, say more why you don't think NPS is the right or is overrated, and what's either alternative or what's the best way to evaluate what your what customers think.
I think like the best way to evaluate is to actually talk to them. But I call Net Promoter Score the Ozempic of metrics. They both offer the illusion of progress, addictive simplicity, a measure and not a long-term solution, diminishing returns, and pure vanity. And so I'm gonna sound like a crazy person. Like I wrote like a manifesto on why I hated NPS. But basically, NPS, there's no actionable insights. It's like, what do I do with this? 83. It's like, all right, high five.
All right, I think that is it. I will continue the video another day. Make sure if you liked any part of what happened today, you subscribe. I'm going to continue dropping more videos, going live, trying to find some decent stocks to continue to look at. Appreciated the conversation that we had here with John, and I hope he comes back and look, it shows that his investment strategy maybe changed a little bit. As an investor, you shouldn't just follow what you see on social media. hype can be created out of anything, only looking at the good side and not the bad side. FOMO, fear of missing out. Don't fear of missing out on any stock. You can always buy in. If it's a good company, it will keep going up. So you don't feel like you have to jump in now, or you're gonna lose. You're never gonna be able to get in again in the prices that you need to. Um, that's really is like one of the biggest lessons. The long-term game is always a win, and some of these companies can win faster than you can imagine. um, so any investment can seem like a gamble. So actually every investment is a gamble, hoping the management executes as they promise and the business and the economy continues as it does. So you never know which way things are going to go, but as long as you invest in great managers and great businesses, the business is going to continue to operate. You look at a company like Apple, you look at a company like Amazon, you look at a bank like Wells Fargo, or a newer bank like SoFi. You look at Charles Schwab. Any of these large companies, no matter what happens in the economy, whatever changes, they always come back. So don't be fearful of investing. I think it's always good to invest. Even if you lose a little bit of money, at least you've learned a lesson from it. So that is, I think, the most important thing. I may have to make an exclusive video around this topic, because I think investors get very fearful, or maybe FOMO kind of takes over, and they think that they have to buy in a high growth, tiny market cap company, um, and really take a risk on those companies without really understanding the the foundation that they're built on, which is their financial statement and their managers and the business. So those are key features of a business. So with that said, though, thank you so much for joining me. If you like this video, make sure you subscribe. I will probably go live tomorrow again. We'll see how tired I am. But if you have ticker symbols that you want me to talk about, go ahead and drop them in the comments in one of the videos, and I'll see it. Thank you so much for joining me today. Have a good night. Peace.
It's like I don't